Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, today we're jumping into a book that basically tells you to forget almost everything you thought you knew about investing. We're breaking down the Motley Fool Investment Guide, and we're going to show you how a little foolishness might be the smartest move you ever make. So this whole thing was started by two brothers, David and Tom Gardner. And their idea was, pretty radical, that you, the regular person, can not only play in the stock market, but you can actually win. Their whole mission is to wrestle power away from the big shot institutions and put it right back where it belongs, with you. And this quote right here, it's one of the first things you see in the book. And man, it really sets the stage for everything we're about to talk about. It's a direct challenge to the old guard, a little hint that maybe, just maybe, the best ideas come from thinking differently than everybody else. So that leads to this huge question, right? Is the whole Wall Street machine, with all its fancy jargon and complicated advice, really set up to help you? Or is it maybe, just maybe, designed to help itself? That's the big conflict we're going to get into. Okay, so first things first, we got to understand the game that Wall Street wants you to play. They have a very specific playbook, their own brand of wisdom that they push on everyone. But as you're about to see, that playbook often works out way better for them than it does for you. And wow, look at this. It's like night and day, right? On one side, you have what they call wisdom, with a capital W, which is all about what's happening this quarter, using confusing words, charging you a ton of fees, and telling you that you can't possibly do it yourself. But then you have foolishness. It's all about the long game, demanding things be simple and clear, and most importantly, it's built on the belief that you are in the driver's seat, and you can absolutely win this game. All right, so if that's the wise way, which, let's be honest, sounds kind of stressful, what's the other option? Let's dive into the foolish strategy. It's a totally different path, one that's designed for people like us to actually come out on top. And just to be super clear here, when we say foolishness, we're not talking about being reckless or dumb with your money. Actually, it's the complete opposite. It's about being disciplined enough to question the so-called experts, to control those gut reactions of fear and greed, and to focus on a timeline that's measured in years, not minutes. And here it is. This is the core belief that drives the whole thing. It's not just a hopeful little saying. The Gardners argue, with tons of evidence, that individual investors aren't at a disadvantage at all. In fact, with the right mindset, they can actually do better than the pros. But you're probably thinking, hang on, why mess with Stokes at all? I mean, they can go down, right? Isn't it just safer to stash my cash somewhere? And you know what? That's a totally fair question that pretty much everyone asks when they're starting out. Well, this chart tells the whole story. I mean, just look at these numbers. It's absolutely mind-blowing. If you put $100 in an account with no interest over nearly a century, inflation would have basically wiped it out. With gold, you barely made a profit. Government bonds? Okay, not bad. But look at stocks. That same $100 became over $700,000. That right there is the insane power of owning a piece of great American businesses over time. So suddenly, the goal gets super simple, right? The general stock market, the S&P 500, it averages about a 10% return a year over the long haul. The whole point of being a foolish investor is to find a way to beat that average. Because those extra percentage points, well, that's where life-changing wealth is made. Okay, so we know what we want to do, beat the market. But the big question is how? Well, the book lays out two really cool, distinct paths. Let's start with Tom Gardner's strategy, which is all about finding the best companies on the planet and just holding on tight. Tom's whole philosophy is about finding what he calls everlasting stocks. He's not playing for next week or next month. He's looking for companies you can literally buy and just hold for years, maybe even for the rest of your life. It's all about quality and extreme patience. And the best part is how you find these gems. It's not about complex financial models. It's about using tools you already have, things Wall Street pros completely ignore. You can watch a CEO give a talk on YouTube to see if they're genuinely passionate. You can scroll through Amazon reviews to see if customers are truly loyal. These are the little clues that give you, the individual, a massive edge. All right, so that was Tom's approach. Now let's flip the coin and look at his brother David's strategy, rule breaker investing. This one is all about hunting for the innovators, the game changers, finding the next big thing before anyone else does. So this is all about finding the rebels, the companies that are just tearing up the old rulebook in their industry. Think about what Amazon did to shopping or what Netflix did to movies. David's whole system is designed to help you spot these companies while they're still in that explosive growth phase, when the potential is just astronomical.
And David has this awesome, super simple test. He says, a truly great stock, a real rule breaker, shouldn't take 2 minutes to explain. It should take one sentence, just one. If you can't nail the core idea that simply, it might not be as great as you think. The biggest ideas are often the easiest to grasp.
So look, whether you're more of a buy and hold forever type like Tom or a find the next big thing type like David, both of these strategies are fueled by the same secret sauce. And that is the incredible, almost magical power of compounding. This is the real reason we do all this. You know, when you first start, it can feel kind of underwhelming. You put in 10 grand and a year later you've made what, maybe 800 bucks? It's so easy to get impatient and think, is this even working? But that's short-term thinking, and it's a trap. And this is where the magic really happens. Every little extra percentage point you can squeeze out, it doesn't just add up, it multiplies over time. It snowballs. That's the mind-blowing part of actually owning a piece of a great business instead of just watching numbers on a screen. Okay, let's put some real numbers to this because this is where it gets really exciting. Check this out. The book runs this scenario. You start with 25 grand, you add just 2,500 bucks a year, and you manage to get a 15% return, which is the goal, right? To beat the market. In 23 years, that's $1 million. This isn't fantasy, it's just math. So that really just leaves one last question for you to think about, a big one. The choices you make with your money today, the patience you learn to have, all of that is going to decide what your life looks like decades from now. Where are you going to be? Look, becoming a foolish investor isn't an overnight thing. It's a journey. It takes patience and a little bit of courage to go against the grain. But hopefully, this gives you a new way to think about it, a new framework to start with. Fool on. Fool. You hear that word, and what do you think of? It's probably not the first thing you'd pick for a financial company, right? Seems totally counterintuitive, maybe even a little nuts. But what if I told you that embracing your inner fool might just be the wisest thing you could ever do with your money? Let's dig in. You know, this idea, it's not some new, crazy concept. We're talking centuries ago. The writer Rabelais pointed out that, hey, sometimes wisdom comes from the most unlikely places. It's a really powerful thought, and it totally sets the stage for looking at the world of finance in a completely different way. A way that makes you ask, who are the real fools here? All right, so here's our game plan. First, we're going to take a look at the so-called wise folks on Wall Street. Then, we'll get into why on earth anyone would call themselves fools. We'll follow their story from a backyard shed to a global screen, break down their foolish way of investing, and finally, we'll look at the proof that shows, hey, this stuff actually works. Okay, so to really get what the fool is all about, we've got to start with what it's not. And that's the old school established wisdom of Wall Street. It's an entire industry built on a very specific, very powerful image. But what happens when you peek behind the curtain? And this is where it gets really interesting. On one hand, you've got this whole image, right? The pinstripe suits, the fancy cufflinks, the slogans that scream confidence. But then you look at the reality, the cold, hard numbers, and they tell a completely different story. More than 8 out of 10 of these professional money managers, the wise ones, can't even beat the market average, year in and year out. That's just staggering. So it really makes you wonder, right? All that stuff, the giant desks, the expensive suits, the precision watches, what's that all for? Is it there to impress you, to maybe intimidate you a little? Or could it be that it's all just designed to overcompensate for a track record that isn't all that great to begin with? It kind of forces you to rethink what real wisdom even looks like. And that's what brings us right back to the central idea here. I mean, if the so-called wise are consistently falling short, maybe, just maybe, it's time to try a totally different kind of wisdom. The wisdom of the fool. Now, let's be real for a second. Have you ever done something, well, kind of foolish with your money? Come on, most of us have. Maybe you bought a stock because your dentist gave you a hot tip. Or you clicked on one of those emails promising a can't-miss stock. Or maybe you piled into the mutual fund that was the hottest thing last year. We've all been there. And a lot of times, the financial industry actually profits from those exact impulses.
But this is where the Motley Fool completely flips the script on that word. They looked way back to Shakespeare's plays at the court jester. See, the fool was the only person in the entire kingdom who could walk up to the king, the most powerful person around, and tell him the absolute, unvarnished truth and not lose his head for it. They used humor to deliver wisdom no one else dared to. Yeah, the name itself is pulled straight from a line in As You Like It. A motley fool literally refers to the jester's colorful, patched-together outfit. It's a perfect metaphor for bringing together a patchwork of different ideas and having the guts to stand out from the crowd and speak a different kind of truth.
So you've got this wild, contrarian idea. How in the world does that become a huge company? Well, the origin story is just as unlikely as the name. It didn't begin in some fancy Wall Street tower. Nope. It started in a tiny little shed in a backyard.
I mean, look at this. It started so small. 1993, two brothers, David and Tom Gardner, launch a printed newsletter from a 12 by 8 foot shed. That's it. But then, just a year later, they make a brilliant move. They partner with this new thing called America Online, or AOL, and just like that, their message goes from a handful of people to a global audience, paving the way for the massive company they are today. And when you dig into the details of how they started, it's just fantastic. They learned about business from their dad, who taught them that buying a stock just means owning a little piece of a real company, even if it's just one that makes chocolate pudding. Their very first newsletter, they mailed it to a list they borrowed from wedding invitations and got a whopping 38 subscribers. But then they got on AOL, started a real money portfolio to prove their ideas, and in the first year, it beat the market by almost 40 percentage points. Yeah, that got people's attention fast. Okay, so what was this method? What were they doing that got those incredible results? It wasn't some complex, secret formula only geniuses could understand. Actually, it was the total opposite. It was all based on common sense, and it flew in the face of everything Wall Street was telling people to do.
And really, it all boils down to this huge difference in advice. The so-called wise advice often pushed people into complicated mutual funds with high sales fees and told them to constantly trade in and out of stocks, all of which, surprise, surprise, makes a lot of money for the broker. The foolish advice, on the other hand, was all about putting the power back in your hands. Cut out the middleman, buy shares in great companies directly, and, this is the big one, hold on to them for the long haul. The whole philosophy is built on one simple belief. Nobody cares more about your money than you do.
So here's the game plan, broken down into 4 simple steps. Step 1, buy shares of great, solid companies. Step 2, sprinkle in a few more exciting, maybe more volatile growth stocks for extra potential. Step 3, and this is the most important part, hold on for the long haul. We're talking decades, not days. And it's all wrapped up in step 4. You are the best person to manage your own money, period.
All right, a cool philosophy is one thing, but does it actually, work? Are there real numbers to back up this foolish idea of just buying and holding for a long time? Oh yeah, let's look at the proof. So if you try to play the short game, hopping in and out of stocks every day, well, look at this. Your odds of making money are about 52%. That is basically a coin flip. This data goes back over 140 years, and it shows that short-term trading is really just gambling.
But, and this is the big one, look what happens when you just zoom out, when you extend your timeline. This is incredible. Over that exact same time period, from 1871 to 2012, there has never been a 20-year period where the stock market lost money. 100% of the time, 100 long-term investors made money. That single stat might be the most powerful argument for buying and holding that exists.
And it's not just about not losing money either. It's about winning. A huge study by Credit Suisse looked at this across the entire globe. And what did they find? Stocks have historically been the best performing place to put your money, by a long shot. I mean, in 27 out of 28 markets they looked at, stocks beat bonds and they beat cash. The evidence is just overwhelming.
And if you need one more piece of proof, this just about seals the deal. This isn't them tooting their own horn. This is from Mark Hulbert, a guy who has independently tracked the performance of investment newsletters for decades. And he reported that for a 5-year stretch, the top 3 spots in his rankings, out of more than 200 services, were all held by the Motley Fool. That is some serious third-party validation.
So, it all comes down to this. This is the question at the very heart of the whole foolish idea. When you strip away all the fancy suits and the confusing jargon, the choice is actually pretty simple. Who's best suited to manage your money? Is it someone whose main investment is in the fees they charge you? Or is it the one person in the world who is most invested in your success? You? The foolish answer is simple. It's time to trust yourself.
So what if I told you that the absolute smartest thing you could do with your money is to be a little foolish? Yeah, I know, it sounds completely backward, but today we're going to dive into a really powerful financial philosophy that's actually called foolishness. You know, this isn't some brand new idea. Shakespeare himself wrote that foolery shines everywhere. But the question we're asking is, can we actually harness a very specific kind of foolishness? What if being a financial fool is, strangely enough, the smartest path you can take? Okay, let's just be honest, right? This is the question that's on everybody's mind. It's the big promise dangled in front of us by so much of the financial media. But look, if you came here looking for some get-rich-quick scheme, I'm going to tell you right now, this isn't it. We're about to explore something so much more sustainable and, honestly, way more powerful. So here's our game plan. We're going to start with the get-rich-slow approach and talk about why conventional wisdom is so dangerous. Then, we'll get into the real heart of it, why true wisdom means going against your gut instincts, especially when it comes to the two big traps, chasing wealth and the illusion of total security. And finally, we'll lay out the whole foolish path forward. All right, first up, the get-rich-slow approach. You know, in a world that's all about day trading and sound bites, where our attention spans are getting shorter and shorter, we are deliberately, intentionally taking the long view.
The core idea here is just this. Investing is a journey, and it's measured in years and decades. It is a lifelong pursuit that, when you do it right, sets you up for the future you actually want. You know, whether that's retiring early, traveling the globe, or, as the source material kind of hilariously suggests, installing a 2-story chocolate waterfall in your house. Hey, whatever it is, the point is, it's all about patience and having those long-term goals.
Okay, so let's move on to what I think is the single biggest obstacle in our way. And that is the danger of conventional wisdom. In our hyper-connected world, bad ideas and bad thinking circle the globe faster than ever. It's absolutely critical that we learn how to separate the useful signals from all of that noise. You know, this quote from the tech commentator Walt Mossberg, it's from the early days of the internet, back when 10,000 bytes of junk actually seemed like a lot. I mean, can you imagine? Today, we're dealing with terabytes of it. It just perfectly captures how easily true wisdom gets completely drowned out, making it harder than ever to find those few little bites of genuine value. So how do we fight back? Well, this brings us to the very heart of the foolish philosophy, and it's this. True wisdom comes from going against your instincts and having the guts to challenge conventional thought. Let's just look at the difference side by side. On one hand, conventional wisdom screams at you to go with your gut, trust the talking heads on TV, and react to every little dip and spike in the market. The foolish approach? It's the complete opposite. It's about resisting those impulses, actually thinking for yourself, and staying patient through all the inevitable ups and downs. And what exactly are those instincts we need to fight against? Well, they really boil down to two incredibly powerful, primal emotions that are the absolute worst enemies of good investing: fear and greed. These are our default settings when it comes to money, and I promise you, they will consistently lead us down the wrong path if we let them.
And who better to explain how to handle this than Warren Buffett, right? His famous saying isn't just some clever line. It's a practical guide for literally inverting those basic instincts. It's all about buying when everyone else is freaking out and panic selling, and being cautious when everyone else is euphoric and piling in. It is the absolute essence of going against the herd.
Okay, let's really dig into that first instinct, greed. Or, as we're calling it, the trap of chasing wealth. There's a great story about the novelist Joseph Heller. Someone asked him how he felt that a billionaire made more in a single day than his classic novel Catch-22 had in its entire history. And he just replied, "I've got something he can never have, the knowledge that I've got enough." It's this endless chase for more that leads people to take really stupid gambles.
I mean, take this cautionary tale. There's a dentist who is about to invest his money in Microsoft, but then he gets a call from a broker who convinces him to put it all into platinum on margin. Now that means he borrowed money to make an even bigger bet. Well, just a few days later, the market dropped. He got a margin call and ended up having to put thousands of dollars on his credit card just to cover his losses.
Or what about the screenwriter who saw a stock that had plunged from $2 all the way down to 25 cents? He thought, what a deal. He didn't even bother to check what the company did. He just figured, hey, if it was a good buy at $2, it must be an incredible bargain at a quarter. Well, a few months later, he got a bankruptcy notice in the mail. Both of these are just perfect examples of greed totally overriding common sense.
So, what do we learn from these kinds of mistakes? The lessons are pretty clear. First, never ever invest in anything you can't explain to a friend. Second, always question the incentives of the person who's giving you advice. And most importantly, you have to actively fight that little voice in your head screaming for a quick win, because the market rewards patience above everything else.
All right, let's flip the coin and look at the other side. The second great danger, the illusion of total security. This one's driven by our instinct for fear, and as counterintuitive as it sounds, playing it too safe can be just as destructive to your long-term wealth as being too greedy.
I mean, this data just paints such a stark picture of what happens when you play it too safe. Check this out. $1 invested in safe treasury bills from 1926 all the way to 2014 grew to just $21. Okay, but that same dollar invested in large company stocks, it grew to over $5,000. That huge difference is the massive hidden cost of giving in to fear.
This right here, this is one of the most important takeaways from this whole thing. The biggest financial risk, the one that people almost never talk about, isn't losing money. It's not taking enough risk to actually grow your money and stay ahead of inflation.
Now, look, this isn't to say that stock market risk isn't real. It absolutely is. I mean, during the Great Recession in the late 2000s, American households lost over $15 trillion in net worth. The market can be brutal, but the key is understanding that consciously taking on this kind of smart risk over the long term is still the best path we have to building wealth.
So, with all of this in mind, what is the foolish path forward? How do we actually put these ideas into practice and start to adopt a new and hopefully much more effective way of thinking about our money?
Well, the foolish path really just boils down to these 4 actions. Number 1, understand your instincts. You got to recognize when fear and greed are pulling your strings. Number 2, question everything. Challenge the experts, challenge common knowledge. 3, take smart risks and understand that they are necessary for any real reward. And finally, number 4, play the long game. Think in years and decades, not days and months.
Ultimately, it really all comes down to this: resisting your gut instincts, ignoring the shouting crowd, and embracing patience. It's not easy. It takes real discipline and courage. So the final question isn't about market timing or the next hot stock tip. It's about your mindset. Are you brave enough to be foolish?
You know, the world of investing has gone through, well, a seismic shift. If you can remember a time when the Macarena was topping the charts, you'll know that investing back then was a completely different beast. It was slower, way more expensive, and honestly, it was kind of a chore. So today, we're going to take a journey from that old world to the incredible power that you now hold literally in the palm of your hand.
Okay, let's just jump right in, because the contrast between then and now is, well, it's wild. On one side, you had the old way, paying up to $100 for a single trade, waiting weeks for company info to show up in your mailbox, and having to physically pick up a phone and call a broker. But on the other side, that's your world. We're talking $0 commissions, instant data, and trading on an app. The transformation is just staggering. So let's actually travel back to that different world for a minute. Just picture it. This is a pre-digital era where investing was an entirely manual, slow-moving process. And you know, it really felt like it was designed by professionals for professionals, which left most everyday people completely on the sidelines. I mean, this whole process required a level of patience that's almost unimaginable today. Forget Google. Your research literally started by flipping through actual newspapers to find stock prices. If you wanted a company's annual report, you had to mail a physical request, and then you'd wait for weeks. Only then could you finally call up your broker to place the trade. It was a marathon, not a sprint, that's for sure. And if that whole process wasn't complicated enough, get this. Stock prices weren't even listed in simple dollars and cents. Nope, they were listed in fractions, like 1/16ths of a dollar. It was this deliberately confusing, insider-focused system that made it hard for an average person to even figure out the basic price of a stock. And here it is, the final massive hurdle, the cost. After all that research, all that waiting, when you were finally ready to buy a stock, the fee just to execute the trade could be anywhere from $40 to $100. That single fee was this enormous barrier that effectively locked millions of people out of the market.
But then things started to change. A movement began, right? A push to level the playing field and give the individual investor, the little guy, a fair shot. And this wasn't just about technology, this was about fairness.
A real game-changing moment in this fight came in the year 2000. It was called Regulation Fair Disclosure, or Reg FD for short. And this SEC rule was simple, but it was totally revolutionary. It said that companies could no longer give secret briefings or early access to information to Wall Street pros. It basically ended the era of the wink and a nod and said that all investors, big and small, had to get crucial information at the exact same time. And this change wasn't just handed down from on high, it was really powered by the people. When the SEC asked for public comments on this new rule, they were flooded. An incredible 3,800 of those comments, that's 65% of the total, came from everyday investors in the Motley Fool community. It just proved the immense power of individuals when they band together. This advocacy didn't go unnoticed either. Major publications like The Economist started to take note of these new investor-first communities. They even called the Motley Fool an ethical oasis in a financial world that, let's be honest, often seemed confusing and hostile to outsiders. And the validation came from the very top. The SEC chairman himself, Arthur Levitt, personally acknowledged the impact of this movement. He called the organization as close to being an effective investor advocate as any organization in America. I mean, that was a massive win for every individual investor out there. Okay, so now let's turn to the other major catalyst here, the technological tsunami. Because while this whole fight for fair rules was going on, a digital revolution was simultaneously tearing down the old walls of Wall Street from a completely different direction. This innovation just came in a rapid cascade. First, you had online discount brokers show up, and they slashed those $100 commissions down to around $10. Then, in 2001, decimalization was finally mandated, getting rid of those confusing fractions for good. And behind the scenes, you had more powerful computers that meant trades could execute in seconds, not minutes or hours. So, after all that change, both the rules and the tech, what does the world of investing look like for you, right here, right now? What kind of power do you actually have? Well, this is your modern arsenal. You have low-cost, often free online brokerages. You've got powerful stock screeners that let you hunt for companies based on your exact criteria. You get instant access to the same official reports and filings that the pros use. You can even buy partial shares, which means you don't need thousands of dollars to own a piece of a great company. The barriers are just gone. The ease of getting started today is almost unbelievable compared to the past. Forget about making appointments at a broker's office with all the mahogany desks. You can literally sign up for an online brokerage account from your couch, in your pajamas, in just a few minutes. It's that simple. And what this all really means is that the financial barrier to entry has essentially vanished. With commissions near zero and the ability to buy fractional shares, you can realistically start your journey as an investor, as a stock picker, with just a couple $100. So, we've established it. The gates have been thrown wide open, the information is accessible, the costs are minimal, and the power is truly, truly in your hands. Which, of course, brings us to the most important question of all. So from a practical standpoint, you are absolutely ready to roll. All those old hurdles we just talked about have been completely shattered. That high cost that locked people out? Gone. The slow pace of information that just wasted time? Gone. The unfair scales that tipped in favor of insiders? They've been balanced. The path is clear for you. But this all leads us to the final and really the most important question. We've spent all this time showing you that you can easily buy individual stocks, but now you have to ask yourself, should you? Is picking individual companies the right path for your financial goals, or are there other ways to invest that might be better suited to your needs? The power is now in your hands, and so is the choice.
Investing can feel overwhelming, right? It's like you're trying to navigate this maze of jargon and risky bets. But what if there's a much simpler, more reliable way to build your wealth for the long haul? Well, in this explainer, we're going to find that clear path forward.
So here's the game plan. First, we're going to dive into the high-stress world of trying to pick individual stocks.
Then we'll shift gears to the mutual fund solution, and I'll give you a super practical 5-point checklist to find the really good ones. We'll also cover the big mistakes you need to avoid, and finally, we'll show you how to put your retirement savings on true autopilot.
All right, let's kick things off. We've all felt that pull, that temptation of the hot tip. You know, that one piece of can't-miss advice about a stock that's just guaranteed to be the next big thing. It's a powerful feeling.
So, picture this. Your phone rings. It's a broker, and he is just buzzing with excitement. He's talking about this company you've never heard of, Huge Fruit Incorporated. He's going on and on about their game-changing lemon larger technology, and he asks you, got any idea how many gallons of lemonade can be squeezed out of a 15-pound citrus?
I mean, who knows, right? But it sounds like a ton of lemonade. The idea of getting in on the ground floor of something huge, it's incredibly tempting. So you say, yep, pull the trigger. But what happens next?
What happens next is a total stress fest. Your investment in Huge Fruit is all over the place. One day it's up, and you can't help but feel like a genius, maybe even bragging a little. But the next day it's way down, and you get that horrible sinking feeling in your stomach. This right here, this is the emotional roller coaster of being a stock speculator.
But listen, there's a much calmer alternative to all this volatility and heartburn. It's the mutual fund solution. And it's a path that is specifically designed not to keep you up at night worrying.
So what in the world is a mutual fund? It's actually pretty simple. Imagine a giant pot of money. Thousands of investors, people just like you, all chip in. Then, a professional manager takes that huge pool of money and buys a whole bunch of different investments. We're talking dozens, sometimes hundreds, of different stocks or bonds.
And the benefits here directly fix the problems we saw with picking just one stock. You get instant diversification, which means you're not betting your entire future on one company. You get professional management, so someone else is doing all the heavy research. And with accountability and transparency, you can actually see how they're doing. And all of that leads to the biggest benefit of all, real peace of mind.
And this quote just nails the power of that first point. See, in the investing world, if you want higher returns, you usually have to take on more risk. But diversification? It's the one amazing exception. By spreading your money out, you lower your risk of one bad apple sinking your whole portfolio, and it doesn't cost you a thing in expected returns. It is literally the closest thing to a free lunch you will ever find.
The appeal is pretty obvious, right? And because of that, the industry has absolutely exploded. There are now almost 10,000 different mutual funds just in the US. To give you some perspective, that's roughly one fund for every single Starbucks in the country. So, with that many choices, how on earth do you pick the right one?
Well, that brings us to the practical part, your 5-point checklist. Think of this as your personal toolkit for cutting through all that noise and finding the high-quality funds that are actually worth your hard-earned money. Okay, here are the 5 key questions you need to ask. Number 1, how long has the manager been around? Experience is huge. 2, do they have a consistent process they stick to, or do they just chase whatever is hot? 3, and this one is critical, are the fees low? 4, how did the fund do during a big market crash? And finally, 5, is the fund company focused on its shareholders? In other words, do the managers invest their own money in the fund?
Let's just zoom in on fees for a second, because this is a massive deal. Some funds have something called a load. It's just a fancy word for a sales commission, often more than 5%, that gets paid to a broker. It's skimmed right off the top of your investment before it even has a chance to grow. No-load funds? They don't have that. Your entire investment goes to work for you from day one. It's a no-brainer.
And if you're wondering why fees matter so much, just look at this. Over a 10-year stretch, the vast majority of professional fund managers, the people you're paying big fees to, actually failed to beat the market's average return. Think about that. You're paying extra for underperformance. Keeping your costs low is one of the most important things you can do. So now that you know what to look for, it's just as important, maybe even more important, to know what to avoid. There are some really common traps out there that investors fall into all the time, and they can absolutely sink your portfolio.
The first huge mistake is chasing performance. It's so tempting to look at what was the #1 fund last year and dump all your money into it. But that's like trying to drive by looking only in the rearview mirror. It's a classic recipe for buying high and selling low. The second trap is following trends. You know, getting sucked into these gimmicky, overly specialized funds, like a fund that only invests in one tiny niche. For most of us, they're just way too risky and expensive.
And speaking of unnecessary risk, let's check back in on our hot tip, Huge Fruit Inc. Oh, the news just broke. Turns out the FDA rejected their lemon larger technology because of some, let's just say, unsettling side effects. The stock has completely cratered. It's down 76% in one afternoon. Ouch.
So could you have seen this train wreck coming? Well, yeah, probably. Some decent research would have shown the company had no other products and a really shaky financial situation. And that's the absolute beauty of a good mutual fund. You are handing off that time-consuming, critical research to a whole team of pros whose entire job is to avoid these kinds of disasters.
Now, what if all that still sounds like a bit too much work? What if you don't even want to mess with a 5-point checklist? Well, for a true set-it-and-forget-it approach, there's one of the best innovations in modern investing.
It's called a target date fund. And honestly, the best way to think of it is as a pre-packaged, all-in-one portfolio. You just pick the fund with the year closest to when you think you'll retire, say the 2055 fund. That's it. The fund then handles all the complicated decisions for you, automatically becoming safer as you get older.
And the magic behind this is something called the glide path. So a fund for someone who's retiring way out in 2065 is going to be mostly in stocks for high growth. But a 2025 fund for someone who's almost at retirement, that's going to be mostly in safer bonds to protect their money. The fund makes this gradual shift for you year after year without you lifting a finger. It is truly investing on autopilot.
And that really gets to the heart of this whole thing. Whether you're carefully picking your own funds or you're using an all-in-one target date fund, the core principle is exactly the same. Your investments should be a source of security, not a source of stress. A portfolio should never, ever keep you up at night.
It's so easy to get spooked by the daily news and the market's ups and downs, but it's so important to just zoom out. When you look at the long-term history of the market, it's a story of incredible resilience. It's a steady march upward that has survived every single crisis and storm that's been thrown at it. Your greatest allies are patience and a long-term view.
So we'll leave you with this final thought. Take a hard look at your own approach to investing. Is your money working hard for you, quietly building your future in the background? Or is it just making you work hard with constant stress and worry? As we've seen today, that choice is entirely yours to make.
All right, let's dive right in. We're going to look at one of the most common ways people invest, something you probably have in your own retirement account. But here's the thing. There's a huge, costly secret hidden inside it. It's this quiet drain on your money that over your lifetime could literally cost you millions. So, what is this mystery? Let's untangle it.
Okay, our investigation starts with just one single startling number. And honestly, when you first hear it, it just doesn't make any sense at all. 82%. So what is that? Well, according to Standard & Poor's, that's the percentage of professional, large-cap mutual fund managers, the folks who manage funds that invest in the biggest companies like Apple or Amazon, who fail to beat the market's average return. And that's over a 10-year period. I mean, let that sink in for a second. These are the experts, the pros, the people you pay to be smarter than average. And yet more than 8 out of 10 of them are losing to the average. But wait, it gets even worse. You see, that 82% number is actually optimistic. It's got this thing called survivorship bias. Basically, that stat only looks at the funds that were still around after 10 years. It totally ignores all the funds that did so terribly that they just poof, shut down and disappeared. So the real failure rate? Yeah, it's even higher than that.
The source material we're drawing from has this perfect analogy for how crazy this is. Think about it. It's like finding out that 80% of English professors would actually score worse than their own students on a big exam. You're paying this expert for their knowledge, but you would have done better on your own. It's completely backward, right? And it really points to a huge, fundamental problem with how this whole industry works.
So this is the big question, isn't it? How is this even possible? You've got these managers with billions of dollars at their fingertips, entire teams of brilliant analysts, and they still can't do the one thing they're paid to do. It just doesn't add up. So for the rest of our time here, we're going to play detective and uncover the clues that explain this massive failure.
All right, clue number 1. And honestly, this is probably the biggest piece of the puzzle. It all comes down to the money that gets skimmed off the top of your investment before you ever see a dime of profit. So here's the real kicker. It's not that these fund managers are necessarily bad at their jobs. The real problem is that they're starting the race 50 yards behind the starting line.
Every single year, they have to make up for all their own fees, their trading costs, their big salaries, just to get back to zero. Beating the market is a whole other mountain to climb after that.
This chart really says it all. You see that big bar on the left? That's what the market returned. Pretty good, right? But then, look what happens. A chunk gets taken out for fees, another chunk for taxes, and that little bar on the right, that's what you actually get to keep. Every single penny they take in fees is a penny that's not in your pocket, not compounding for your future. And believe me, those costs add up way faster than you think. Get this number, 90%. That's the average turnover rate for a stock fund. That means they're basically selling and buying almost their entire collection of stocks every single year. All that churning isn't free. It generates massive trading costs and, even worse, it creates a big tax bill from capital gains, a bill that gets passed right on to you. Okay, this is where it really hits home. Let's make it personal. Say you invest 10 grand. In your typical mutual fund, after they take their cut, maybe you end up with an 8% return. 30 years later, you've got $100,000. Not bad. But what if you just put that same 10 grand in a super simple, low-cost index fund that just mirrored the market? You'd be looking at over $220,000. That's more than double the money. That difference, that's the cost of fees.
Okay, on to clue number 2. This one is less about the numbers and way more about, well, marketing tricks and flat-out deception. It's a shady little practice they call window dressing.
And window dressing is pretty much exactly what it sounds like. It's all about making the fund's holdings, the shop window, look way better than it actually is. Here's how it works. Managers will wait for a stock to get really popular and go way up in price, and then they'll buy it. Not to make money for you, the big gains are already gone. No, they buy it purely so it shows up on their next report and makes them look like geniuses.
Let's just walk through this sleight of hand. So step 1. Some hot new tech stock just explodes. It goes up, say, 45% in 3 months. Step 2. Just days before they have to send out their quarterly report, a fund manager swoops in and buys some shares. Then step 3. The report lands in your mailbox and hey, look at that, they own that hot stock. It makes it look like they were in on the action the whole time when really they just bought it at the top. You, the investor, didn't benefit at all. It's all for show.
And don't just take my word for it. This isn't some conspiracy theory. A Harvard study actually looked into this and found that, yeah, it works. It tricks people into pouring more money into these funds. So it's great for the fund manager's bonuses, but for the actual investors already in the fund, the study found it gives them literally zero benefit. It is purely a marketing gimmick. Okay, that brings us to our third and final clue, and this one might be the scariest of all. It's the fact that when you buy a mutual fund, you're basically handing your money over and putting it inside a black box.
So, why a black box? Well, first off, have you ever tried to read one of those official fund documents, the prospectus? It's written in this impossible-to-understand legal language. The source we're using calls it prospectifish, which is perfect. Second, these funds can own hundreds, sometimes thousands of different stocks. Who has time to research all that? And third, the manager can just decide to go off script, maybe taking on huge hidden risks with things like derivatives. The bottom line is simple. You can't know if it's a good investment if you have no idea what's actually inside.
And because we can't see inside the box, what do we all do? We do the only thing we can. We look at how the fund did last year or over the last 5 years. But this quotes baseball analogy shows just how absurd that is. It's like trying to bet on a baseball game, but you ignore who's playing, you ignore who's pitching, you ignore everything, and you just bet on the team that won more games in the past. It's absolutely ludicrous, but that's exactly what we do when we chase past performance in investing. Okay, the investigation is over. We've got our evidence. Crushing fees, sneaky marketing tricks, and a total lack of transparency. So now it's time for the verdict. Let's put it all together and see the real long-term damage this does to your money. Let's fast forward 40 years. You put $10,000 into the average mutual fund. It grows to about $217,000. You're thinking, hey, not bad, but hold on. What if you just put that same money into a simple S&P 500 index? Look at that bottom row. It would have grown to over $650,000. That's a difference of over 430 grand. That's a house. That's a retirement. Gone.
But the truly mind-blowing number comes when we look at a full 60-year lifetime of working and saving. Look at this. That 10 grand in the average mutual fund, it does it. It breaks $1 million. Amazing, right? A millionaire. But if you had just owned the average, the simple S&P 500, your $10,000 would have turned into over $5.2 million.
Here it is, side by side, the final, brutal verdict. The cost of choosing that expert-managed fund wasn't just a small fee. Over a lifetime, it's the difference between having $1 million and having over $5 million. That's the devastating price you pay for all those fees, for that underperformance year after year.
So there you have it. The case is closed. The evidence is overwhelming. You take the high fees that put managers in a hole, you add in the deceptive marketing tricks like window dressing, and you top it off with a total lack of transparency, and what do you get? Consistently, massive underperformance for regular people like us.
And that leaves us with one last, really important question to think about. We've just seen how incredibly simple and powerful it is to just be average, to just match the market. So why is there an entire multi-billion-dollar industry that spends all its time and money trying to convince you that investing is super complex and that you need them? You have to ask yourself, who really benefits when things are made to seem so complicated?
All right, let's jump right in. Today, we're talking about something called passively managed investments. And look, if you've ever felt like investing is just too complicated or that it takes up way too much time, then this is for you. We're about to unpack a super powerful but surprisingly simple financial tool that could totally change the way you think about your money.
So check out this quote. This right here. This is the dream, isn't it? I mean, imagine an investment that just works. It chugs along with the market, it's totally transparent about what you own, and you don't have to spend your weekends buried in research papers. It's the ultimate set it and forget it dream. Okay, I can hear you now. Sounds way too good to be true. What's the catch? And you're right to be skeptical. But what if I told you this isn't some financial fairy tale? What if this is totally real and actually available to pretty much everyone? And this is how that dream becomes a reality. We're talking about two things: index funds and exchange-traded funds, or as you'll always hear them called, ETFs. These are the engines of the passive investing world, and they're built from the ground up to make your financial life a whole lot simpler. So here's the absolute key. You've got these actively managed funds, right? Think of a manager trying to be a stock-picking genius, trying to find the next big thing. Passively managed funds, they don't play that game. Their goal isn't to be smarter than the market. Their goal is to be the market. They just copy a benchmark, like the S&P 500, which is basically just a list of 500 of America's biggest companies. And this is a perfect example of that whole philosophy in action. You take a giant fund like the Vanguard 500 Index Fund. It's got one simple job: buy all 500 stocks in the S&P 500 Index. That's it. No secret sauce, no genius manager making bets. What you see is exactly what you get. It's an approach that is completely transparent and puts you, the investor, first. Okay, so it's simple, but simple doesn't mean weak. In fact, it's the opposite. This hassle-free approach leads to some seriously powerful advantages. We're not just talking about saving time. We're talking about a path to real, long-term profit without having to become a Wall Street guru. I mean, look at this list. It all just stacks up so nicely. You buy one thing and boom, you're diversified. You can get your nights and weekends back because there's no research to do. You know exactly what you own. But the real kicker, the one that can literally change your financial life, is that last one, the incredibly, unbelievably low fees. Just look at that number, 0.11%. That's it. It's almost nothing. And why is it so low? Well, because these funds aren't paying a team of fancy analysts to make big predictions. They're just following a recipe. And all those savings, they get passed directly to you. And this slide, man, it just puts it in black and white. The difference is just staggering. On one side, you have that tiny fee. On the other, actively managed funds can cost many times more. It's like a slow leak in your retirement bucket, dripping money out year after year. Over a lifetime, that small difference can add up to tens, even hundreds of thousands of dollars that stay in your pocket. All right, so you're on board. You're thinking, passive investing, this is for me. Awesome. But now you've got a choice to make. You're at a fork in the road. Do you go with a classic index fund, or do you choose its newer, flashier cousin, the ETF? Whoa, okay, that's a lot of info. Don't worry, you don't need to memorize the whole thing. Let's just zero in on the big three for most of us, right there at the top: pricing, trading costs, and the minimum amount you need to get started. That's really the stuff that matters day to day. This is the huge selling point for ETFs. They trade all day long on the stock market, just like a share of Tesla or Microsoft. The price moves up and down, and when you hit that buy button, you lock in that price right then and there. It's fast, it's transparent, and you have total control. Now, index funds, they work a little differently. The upside is you often don't have to pay any commission to buy them, which is great, but they only set their price once a day after the market closes. And the other hurdle can be the upfront cost. Many of them require you to have at least $1,000, sometimes more, just to open an account. So the common wisdom, right, what you always hear is that ETFs are just better, cheaper, more tax-friendly, the whole deal. But is that really true? You know what? Let's throw them in the ring and see what the data actually says. Let's get a ringside seat. All right, let's dig into these numbers. Don't let your eyes glaze over. We only need to look at two things here. That middle column, expense ratio. That's just the annual fee. Lower is better. And the column on the far right, the tax cost ratio. Just think of that as how much of your profit got eaten by taxes. Again, lower is better. And right off the back on that first point, cost, the data is crystal clear. Look down that expense ratio column. In every single matchup, the ETF is cheaper. No contest. That lower cost means better performance over time. Ding, ding, ding. Round one, without a doubt, goes to the ETFs. But, and this is a big but, here's where things get kind of weird. Now look at that tax column on the right. In every single case, the old school index fund was actually more tax efficient. It had a lower tax drag. This totally flips the script on what most people believe, and it shows that this choice is a lot more nuanced than you might think. So you weigh the evidence. Cheaper costs for ETFs versus maybe better tax efficiency for index funds. You think you've got it all figured out. But what if I told you none of that actually matters? What if this is just the beginning of the story? The choice seems obvious, doesn't it? ETFs win on cost, they're more flexible, case closed. You just grab a low-cost ETF that tracks the market, and you could ride off into the sunset, right? Well, about that. We're going to take everything we just said, every single point of comparison, and throw it right out the window. You heard me. The final takeaway from our source material is don't buy any of these things. Now, hold on. It's not because they're bad products. They're great. It's because they represent the starting line, not the finish line, because there are ways to potentially do even better. And that brings us to this really cool idea, the foolish investing ladder. Think about it this way. Using one of these index funds or ETFs to match the market's return, that's like stepping onto the very first rung of a ladder. And just by doing that, you are already way ahead of so many other investors. It's a huge step. Seriously, getting on that bottom rung is a fantastic place to be. You should be incredibly proud of it. You've basically guaranteed you won't lose to the market, and you're harnessing its incredible power with almost zero effort. It is a solid, intelligent foundation. But it's still the bottom rung. And so that's the real question we have to leave you with. By mastering passive investing, you get to a place of solid, reliable market average returns, a place most people, frankly, never even reach. The question for you is that your final destination? Or is that just your base camp for a much bigger climb? Will you settle for an excellent average, or will you keep climbing that ladder? All right, today we're tackling a really interesting topic, something a lot of investors eventually start to wonder about. Is there something beyond just buying an index fund? What does it take to actually step away and try to do better? You know, this quote from Walt Disney is the perfect way to kick things off. Because that's what this is really all about, right? It's about curiosity, it's about mastering the basics, and then starting to wonder, what's next? What's down that other path? And that curiosity leads us right to this question, which is really the heart of our entire conversation. An S&P 500 index fund is designed to give you average. And hey, average is a fantastic result. But what if you're aiming for something more? What if average just isn't your final destination? So, to explore that, we're going to climb what I'm calling the ladder of investor evolution. First, we'll see where most people start, with funds that actually underperform. Then we'll step up to that smart, simple, average solution. But from there, we're going to keep climbing, busting some myths, looking at a wild real-world example, and finally mapping out what the path to outperformance really looks like. Okay, so let's start on the very first rung of our ladder. For a long time, if you wanted to invest, you were probably told to go find an actively managed mutual fund. The whole idea was you'd pay a smart manager to beat the market for you. Sounds good in theory, but the reality? Well, it's a little different. Yeah, 80%. Just let that sink in for a second. Over a typical 10-year stretch, more than 80% of mutual funds don't even manage to match the market's average return. So you're paying a pro, and 4 out of 5 times you would have been better off just doing nothing and buying the average. It's pretty staggering. So you have to ask, why? What is going on here? Well, it really boils down to a few key things. You've got frenetic trading, managers buying and selling constantly, which racks up costs. You have high fees because, those fancy offices and big salaries have to get paid somehow. And it all comes out of your pocket. And then there's this relentless short-term focus, this pressure to look good this quarter, which is often the enemy of good long-term decision-making. So when you see a failure rate that high, you'd obviously start looking for a better way, right? And that brings us to the next step up the ladder, the index fund. It is just such a simple, powerful solution. And this is the absolute magic of it. You can buy a simple, low-cost S&P 500 index fund, and you are literally guaranteed to earn the market's average return. With one move, with almost zero research, you are suddenly outperforming 80% of the professionals. It's incredible. And the guy who invented the first index fund, Jack Bogle from Vanguard, is, for this exact reason, considered an absolute hero to everyday investors. He basically gave everyone a fair shot, a way to get their piece of the market's growth without being eaten alive by fees and bad performance. It was a total game changer. Okay, so the index fund is a brilliant tool. It's a fantastic place to be. But this is where a climb gets really interesting. We have to stop and ask ourselves, is being average the final goal? I mean, by definition, an index fund will never beat the market. It is the market. Is that really where you want to stop? So this really lays out the two big philosophies, the two paths you can take from here. On one side, you've got the index fund investor. It's passive, it's simple, and it works. You're guaranteed the market's return. But on the other side, you've got this different approach, what the source material calls the foolish investor. This is an active strategy. It's about looking at stocks as businesses, thinking long-term, and having the specific goal of beating that market average. Now, before we go any further down that second path, we have to deal with the elephant in the room. There's this big, powerful academic theory that basically says trying to beat the market is impossible. It's called the efficient markets theory, or EMT, and it's really the intellectual foundation for the entire index fund industry. The theory says that all public information, everything, is already reflected in a stock's price. The price is always right. And if that's true, then any future moves are totally random, and trying to pick winners is just a waste of time. But here's the thing. If you've ever actually watched the market, even for a day, you know that reality doesn't feel quite so neat and tidy. The market isn't some perfect, logical machine. It's a messy, chaotic, emotional place driven by millions of humans with all their fears and greed. And because of that, it's almost always a little bit wrong. And here are just a few reasons why. You have people focused only on the next 3 months. You have panic. You have euphoria, the full range of human emotion. You have people investing for retirement right next to day traders. Everyone's playing a different game. This mix of goals and emotions is exactly what creates inefficiencies. And for a patient investor, that inefficiency is opportunity. And that gets right to the core of that foolish philosophy we mentioned. It's about leaning into that messiness. It's about seeing the chaos not just as risk, but as the very thing that creates amazing opportunities. It's looking for those moments when the market's short-term emotional price gets disconnected from a company's real long-term value. That gap, that's where you can win. Okay, so let's move away from theory and look at a perfect real-world example of this. You really can't talk about market inefficiency without talking about the great Netflix Quickster meltdown back in 2011. So let's just walk through this, because it was wild. Netflix announced a huge price hike and this really bizarre plan to split the company in two, with the DVD business being called Quickster. The market hated it, customers were furious, and the stock just got crushed. The story was Netflix is over. But if you ignored all that noise and just focused on the business, you saw a massive overreaction. And sure enough, just a few months later, they scrapped the Quickster idea, and by the next February, the stock had already doubled. But here's the real kicker. For the investors who just held on, who focused on the business through all that short-term chaos, they saw a 14 times return over the next 5 years. 14-fold. A perfectly efficient market would never, ever allow an opportunity like that to exist. That was pure emotion creating a once-in-a-decade bargain. And that brings us to the top of our ladder. We've seen that the market isn't this perfectly rational machine, and that these pockets of opportunity absolutely exist. So the message here is pretty clear. Indexing is a fantastic strategy, but if you have the desire and you're willing to do the work to try and do better, then you absolutely should. And you might wonder, why does it matter so much?
It's all about the power of compounding. Beating the market by just 1 or 2 percentage points a year might not sound like a big deal, but over an entire investing lifetime, we're talking about a difference of tens, maybe even hundreds of thousands of dollars. It completely changes the outcome.
Now, a word of warning. This path is not for everybody. It really takes a certain kind of mindset. You genuinely have to enjoy the process of researching companies. You have to think like you're buying a piece of a business, not just a stock ticket you're going to flip. You have to accept that owning individual stocks comes with more risk. And maybe most importantly, you have to be ready to take full responsibility. Your wins are your wins, and your losses are your losses.
So we'll end with this thought. Think of the index fund as your safety net. It's an amazing tool that guarantees you won't get left behind. It's the solid ground, but the ladder is there. And the real question is, are you curious enough to start climbing?
Thanks so much for joining me for this explainer. I'll see you next time.
Ever look at your mutual fund statement and just kind of sigh? You think, is this really it? Is average the best I can hope for? Well, today we're going to dig into an idea that might feel a little radical. The idea that you, have what it takes to leave those funds in the dust and build a portfolio of individual stocks that actually beats the market. I know, it sounds like a tall order, but as you're about to see, you've got some pretty surprising advantages on your side.
This quote from Walter Lippmann, it's perfect for what we're talking about today. See, the court fool wasn't there just to be silly. Their job was to speak the truth, especially the uncomfortable truths that nobody else dared to say. And the uncomfortable truth we're diving into is that the conventional wisdom, the idea that you can't possibly outsmart the big Wall Street giants, might just be totally wrong.
So here's the game plan. First, we're going to uncover your secret weapon, the hidden advantages you have over the pros. Then, we'll look at the hard data, the history that makes an ironclad case for stocks. After that, we'll get practical, how to start, how to keep score. And finally, we'll tackle the 2 biggest mental hurdles, how to handle the crazy market swings, and how to develop the one virtue that matters more than any other.
All right, let's jump right into Section 1, your surprising Wall Street edge. We're always told that we're the little guys, the dumb money. But what if the whole system is actually tilted in your favor? Let's find out.
I know. It sounds a little crazy, right? How could you possibly do better than someone with a fancy degree who does the stuff all day? But here's the thing. It's not about being smarter. It's about the rules of the game. There are actual structural reasons why their massive size and all their rules become their biggest weakness and your greatest strength.
This slide right here, this is the whole story. Just think about it. You've got a fund manager juggling $5 billion. They're getting judged every single week, which forces them to think super short term and just follow the crowd. They're so big they literally can't invest in amazing little companies because they'd buy the whole thing by accident. But you're free. You can be patient. You can think for yourself. You can go hunting for those hidden gems, those awesome little businesses the big guys are completely blind to.
Okay, so the theory feels right. It makes sense. But do the numbers actually back it up? You bet they do. In this next section, we're going to look at the cold, hard data that shows why stocks have been the undisputed champion of building wealth for a very, very long time. So if we're going to play this game, we need a scoreboard. And our scoreboard is the S&P 500. Historically, it's returned about 10% a year. Our goal? To beat that number. It's the one thing most of the pros consistently fail to do, but it is absolutely our target. And history shows us that stocks are, by far, the best tool for the job. To really hammer this home, let's do a little thought experiment. Imagine you had $1 single back in 1802. If you invested it, where would it have grown the most over the next 200 years or so? Let's look at the inflation-adjusted numbers. First up, gold. That $1 would have turned into $4.52. Okay, so it beat inflation, which is nice. It held its value, but it's not exactly going to make you rich, is it?
Now, let's look at long-term government bonds. Whoa, okay, that's a different story. That $1 would have blossomed into $1,778. Now we're talking. That's a very solid return. But just wait.
And here it is, the big one. That same single dollar, if you'd put it in the U.S. stock market, would have grown to nearly $705,000. That's not just a little better, it's a completely different universe. This right here is the incredible, life-changing power of owning a piece of great businesses over the long haul.
The potential is just undeniable. So you're probably thinking, okay, I'm in, but how do I even start? This next section is all about that. We're bridging the gap from theory to action, focusing on two key things: practice and picking the right partner. Now listen, before you risk a single penny of your hard-earned money, the absolute smartest thing you can do is practice. Play the game with fake money first. Set up a mock portfolio. Pick a few stocks you like and just track them. See how you do. You'll learn the mechanics, for sure, but way more important, you'll learn about yourself. What happens when your fun money portfolio drops 10%? Does your stomach turn inside out? Finding that out with Play Money is one of the most valuable and cheapest lessons you will ever learn.
So once you're feeling confident and ready for the real deal, you need a broker. Don't worry, it's not complicated. It's really just a simple 3-step process. 1. Figure out what you care about most. Are you all about the cheapest trades, or do you want amazing customer service? 2. Do a little homework and compare the top guys. And 3. This one is so important, read the fine print. Watch out for those little hidden fees because they are silent assassins that will eat away at your returns over time.
Okay, you've practiced, you picked a broker, you're officially in the game. But how do you know if you're actually winning? That's what this next section is all about. It's time to build your investor's scoreboard. The great physicist, Lord Kelvin, absolutely nailed it. When you can measure what you are speaking about and express it in numbers, you know something. In investing, that's not just a nice idea, it's the law. If you are not tracking your performance with cold, hard numbers, you're not investing, you're just gambling.
So how do you do it? Simple. Use your broker's tools, or some software, or even just a basic spreadsheet. The tool doesn't matter, the discipline does. And you have to subtract every single cost. Commissions, fees, any subscriptions you pay for. The only number that counts is your final net return compared to the S&P 500. And you have to be brutally honest. If you're not beating a simple index fund after all those costs, you got to rethink your strategy.
And now for the part that really scares people. The thing that keeps them huddled in safe mutual funds. Volatility. Those wild, stomach-lurching swings in the market. We're going to face this fear head-on by looking at maybe the most famous roller coaster ride in stock market history, Amazon.
Just look at this. Imagine you bought Amazon back in '97. 2 years later, you were up over 3,000%. You are a certified genius. Then, the dot-com bubble bursts. By 2001, your stock has crashed more than 90% from its high. 90%! Almost everyone would have sold, panicking, but the people who understood the business, who believed in it, and who held on, they were rewarded with a return of over 25,000%. The lesson couldn't be clearer. Gut-wrenching volatility is often just the ticket price you have to pay for extraordinary gains.
So how on earth do you survive a ride like that? You learn to separate the signal from the noise. The daily stock price? That's just noise. Wall Street freaking out about quarterly earnings? Noise. The signal is the long-term health of the business. Read the company's reports once a quarter. Is the story still intact? Is the business still growing? If the answer is yes, then your job is usually to just sit on your hands and do nothing. Fight that urge to constantly trade, because more activity almost never leads to more profit.
And all of this, your built-in advantage, the incredible history of returns, learning to handle volatility, it all leads us here, to our final and honestly our most important section, the investor's ultimate virtue. This is your superpower.
If there is one single rule you need to tattoo on your brain, it's this one. Only invest money in the stock market that you absolutely will not need to touch for at least 5 years. And honestly, longer is way better. This isn't just some friendly advice. This is your foundation. It's what gives you the power to ride out those terrifying crashes like the one Amazon had. It's what lets the magic of compounding really work its wonders.
And of course, Warren Buffett said it best with this classic baseball analogy. Think about it. In investing, there are no called strikes. You don't have to swing at every idea the market throws at you. You can just stand there at the plate and wait and wait and wait for that perfect, juicy, slow pitch right down the middle. Your patience is an incredible strategic advantage. Let everyone else swing wildly at every bad pitch. You can afford to wait for the perfect one.
So in the end, this isn't about being smarter than Wall Street. It's about playing a totally different game. It's a game where your independence, your long-term focus, and most of all, your patience are the winning cards. As we wrap this up, just remember that in this game, patience isn't just a virtue, it's everything. It's your ultimate edge. And the only real question left is, what will yours allow you to build?
You know, when you think about investing, what comes to mind? Probably spreadsheets, right? Charts, maybe some super complex financial models. But what if I told you the single biggest factor that's going to determine your success isn't what you know, but how you think? Today, we're going deep inside the mind of the successful investor.
And this idea, this isn't from just anybody. We're talking about Benjamin Graham, the absolute legend who mentored Warren Buffett. He said, the investor's worst enemy is likely to be himself. That one sentence right there, it sets the stage for everything we're about to cover. The real battle isn't out there in the market, it's right here, in your own head. Just let that sink in for a second. We're not talking about bad advice from some shady advisor, or incompetent CEOs, or even those crazy overpriced funds. Nope. According to our source, your own behavior can wreck your returns more than all of those things combined. It's a pretty radical idea, but it's absolutely crucial. So that leads us right into our first major battleground, our own behavior. See, success in investing has way less to do with what you learn in a classroom and so much more to do with your temperament, your patience, and your ability to just stay level-headed when the world around you is going nuts. Look, you could memorize every finance textbook ever written. You could know every formula by heart. But all of that is pretty much useless if you can't keep your emotions in check. If you can't get a handle on your own built-in biases, you're probably going to have a really unhappy time as an investor. So let's get to know the enemy. First up, let's talk about the big one, fear. Our brains are basically running on ancient software, you know? It was great for spotting a predator in the grass thousands of years ago, but when we apply it to our stock portfolios, it can be an absolute disaster. This is something called loss aversion, and you see it everywhere. Ever notice how a single criticism can sting for days, but a compliment just kind of fades away after an hour? It's the exact same thing with money. We are hardwired to feel the pain of a loss way more intensely than the joy of an equal gain. Okay, but why are we like this? Well, the Nobel Prize winner Daniel Kahneman has a fantastic explanation. It's a deep evolutionary thing. Our ancestors who treated threats, like a rustle in the bushes, as way more urgent than opportunities, like some berries on a tree, were the ones who survived. That instinct kept us alive. But in investing, that same instinct is what makes us panic sell at the absolute worst possible moment, locking in those losses. All right, next up is this little mental game we all play on ourselves. It's called cognitive dissonance. It's that really uncomfortable feeling you get when you believe one thing, but you do another. It creates this tension that your brain just desperately wants to fix. And this slide gives us the perfect everyday example. It's the donut analogy. You know that little voice in your head? Donuts. I know they're bad for me, but you know what? I had a really stressful day. I've earned this. See how that works? We just invent a reason to resolve the conflict. Investors do this all the time, justifying actions they know deep down are probably a bad idea. Okay, so we've talked about fear. Now let's flip the coin and talk about the other extreme, overconfidence. This is where our brains start telling us we're the smartest person in the room, that we've got it all figured out, even when we really, really don't. You've probably heard this one, right? The classic psychology finding where almost everyone thinks they're an above-average driver or have an above-average sense of humor? Well, surprise, surprise. It's the same with investing. The problem is our confidence tends to grow way faster than our actual skill. And if you want proof, just look at this number. In one study, researchers asked investors what they thought their annual returns were. And on average, they overestimated them by a staggering 11.6%. That is a massive gap between how good we think we are and how we actually perform. Oh, this is a big one. We all tell ourselves this story, don't we? That we're going to be the cool, calm, rational one when everyone else is losing their minds. We all make a plan to be greedy when others are fearful. But man, that is so much easier said than done. I mean, think about it. The only reason the market crashes is because way more people are doing the thing on the right than the thing on the left. Simple as that. We overestimate our own self-control, and then when push comes to shove, we find out we are the others we thought we were so different from. Okay, so let's get into our third and final group of biases. These are all about faulty logic, the weird mental shortcuts our brains take that cause us to see connections that aren't there and make some pretty bad decisions. So, anchoring. This one is so common. Here's the deal. The market has no idea what you paid for a stock. It doesn't care. But we get totally stuck on that number, that anchor, and it makes us hold on to a losing stock for way, way too long, just hoping to get back to even. And it's not just about losers. It works the other way too. Imagine you decide a stock is a buy at $40. That's your anchor. But it only ever dips to 42.
So you refuse to buy. And then you have to sit there and watch it soar all the way to 200. Ouch. Your anchor just cost you a massive win.
Ah, the bandwagon effect. You probably know it as herd mentality. It's that simple, seductive idea that, hey, if everyone's doing it, it must be right. But as our source points out, that exact feeling, well, it's the psychological engine behind every single speculative bubble in history. Every single one.
Okay, so we've walked through a whole minefield of mental traps. But there's one more. One bias that sits on top of all the others. It's maybe the most dangerous one of all, because it keeps us from seeing any of the rest.
And here it is. It's called the bias. And what is it? It's that little voice inside your head that's been listening to all of this and saying, yeah, this is really interesting stuff for other people. This doesn't apply to me. If that thought even crossed your mind, congratulations, you're suffering from bias.
And if you think you're too smart for this, just listen to this quote. This is from Daniel Kahneman, the guy who literally won a Nobel Prize for this stuff. And he said, I always felt I was studying my own mistakes. That level of humility from a genius, it's pretty powerful, isn't it? He knew he was the patient, not just the doctor. And that's really what this all boils down to. This is the ultimate edge for an investor. Forget the fancy models for a second. The single most important skill isn't technical at all. It's self-awareness. It's understanding how your own mind can be your biggest asset or your biggest liability.
So that leaves us right here with this one big question. You've now been introduced to the enemy, and the enemy is you. The real question is, what are you going to do about it?
All right, you've decided to do it. You're ready to start investing. But then you log into your brokerage account and boom, instant paralysis, right? You're staring at thousands of companies, ticker symbols, charts. It's a lot. Where in the world do you even begin? Look, it's a feeling every single investor has had, but there's a classic strategy that can really cut through all that noise. Today, we're going to demystify one of the most powerful starting points out there, the world of blue chip stocks. So here's our game plan. First, we'll dive right into that feeling of being totally overwhelmed, what we're calling the investor's dilemma. Then we're going to decode the single most important metric for sizing up a company, market cap. From there, we'll build the case for why blue chips are such a smart place to start, but we'll also get real about why even giants can fall. And finally, we'll wrap it all up by showing you how to build your very own investing playpen.
Okay, so let's really put ourselves in that moment. You've got money in the account, you're pumped, you're ready to make your first move, and you're just staring at a search bar. It feels like an endless sea of options, and the sheer amount of choice is just paralyzing. Do you go with a name you know and trust, or do you take a shot on some wild idea that could be the next big thing?
You know, your first instinct is probably to go with what's familiar, that huge company you practically live in. I mean, think about a place like Home Depot. You see their stores on every corner, their ads are always on. It feels like a pillar of the economy. It feels solid, stable, safe. And honestly, that's an easy first thought, and it's for a very good reason.
But then, your mind starts to wander to the complete opposite end of the spectrum. You've read these articles about some incredible new robotics company. The technology is mind-blowing. It feels like you're looking at the future. But here's the catch, right? It's not profitable. Not even close. It's just burning through cash. It could change the world, or it could just fizzle out and never make a single dime. The upside is massive, but man, so is the risk. Or, hey, maybe it's something even smaller, something you're just passionate about. The source material has this great, funny example, Joe's Fishery Inc., and their hot new product, Salty Sardines. You love the product, you believe in Joe's vision, and if this thing catches on, you could be looking at a life-changing return on your money. But let's be real, it could just as easily go belly up in a year. This is the definition of a high-risk, high-reward gamble.
So, how on earth are we supposed to navigate this whole spectrum of risk and reward? How do we bring some order to all of this chaos? Well, the single most powerful tool we have for this is a little concept called market capitalization. It's really just how the financial world measures a company's size, and it's our best first step to understanding what we're actually dealing with.
Now, don't let that fancy name scare you off. The math here is incredibly simple, I promise. You just take the total number of a company's shares out there and you multiply it by the current price of just one share. That's it. That one number you get, that's the market cap, and it tells you the total value the market thinks that entire company is worth. And once we have that number, we can start sorting companies into different buckets. Think of them like weight classes in boxing. Now, the exact lines can be a little fuzzy, but this is a really solid guide. Up at the top, you've got the heavyweights, the large caps, worth over $4 billion. Then you've got mid caps, small caps, and way down at the bottom, the tiny micro caps. So, our Home Depot example, classic large cap. And poor old Joe's Fishery, oh, he's definitely a micro cap.
Okay, so now that we've got our framework, we're going to zero in on that top bucket, the large caps. In the investing world, these are what we call blue chips. And there are two massive, really compelling reasons why this is probably the smartest place for a new investor to start their journey.
Look, we're not just talking about big companies here. We are talking about the absolute titans of the global economy. These are the household names that make up the major market indexes you always hear about on the news, like the S&P 500, which tracks 500 of the biggest U.S. companies. And just to give you a sense of scale, around the time our source material was written, the average company in the Dow Jones was worth over 182 times billion dollars. These are true giants.
In this slide, this really gets to the heart of it all. It's about a fundamental choice you have to make. When you buy into these stable, large-cap companies, you are investing. It's a calculated, long-term approach. But when you start chasing these unproven, speculative stocks without really doing your homework, that's not investing anymore. That's just rolling the dice. It's gambling. And as the source material perfectly puts it, it's an excellent, long-term approach to losing money.
So reason number one is all about managing risk. Just think about it for a second. We're talking about companies that have been around for decades, with globally recognized brands and just enormous resources. I mean, does anyone really believe that Coca-Cola or McDonald's are just going to disappear by 2030? Of course, nothing's a guarantee, but the odds of them sticking around are incredibly high, and that creates a much, much safer space for you to start learning how this whole market thing works.
And the source material has this brilliant analogy that I just absolutely love. It says that starting with blue chips is like being a child in a playpen. Just pause and think about that image. You're in a safe, contained space. There are no sharp objects around that you can get hurt on. It lets you explore and learn and even have a little fun without the risk of making some catastrophic mistake right out of the gate.
This right here is the whole essence of the playpen. It helps you avoid those early, foolish mistakes that so many people make. It keeps you away from what you could call the financial version of sharp objects, those highly unpredictable, super speculative investments that can just wipe out a new investor's account. It's about being strategic, not just chasing whatever's shiny and new. All right, now for the second huge advantage of this whole approach, let's just start with a number, 6,000. That is roughly how many different stocks are listed on the major U.S. exchanges. 6,000.
I mean, let's be realistic here. Nobody can meaningfully track 6,000 different companies. It's just not possible. Trying to do it is a recipe for burnout and, frankly, for making terrible decisions. And this is the second beautiful thing about focusing on blue chips. It gives you focus. It shrinks your universe from a chaotic 6,000 down to a much more manageable 500. You can actually start to learn about these businesses, do real research, and make informed decisions, which is the whole point of investing in the first place.
But, and this is a huge but, we need a serious dose of reality here. Lower risk is not the same thing as no risk. The playpen is safer, for sure, but it's not indestructible. Even the mightiest of giants can and do fall.
So let me just ask the question that I'm sure is on your mind by now. Are these blue chip investments completely foolproof? Can you just buy them, forget about them, and be totally guaranteed to make money?
Well, as history has shown us again and again, the answer is a resounding no. This slide, it's basically a graveyard of former blue chips. Sears was once a titan of retail, a member of the Dow Jones. Enron was a celebrated energy giant in the S&P 500. These were the blue chips of their day. And now, they're gone. The lesson here is so critical. Even when you invest in the giants, you still have to pay attention.
Okay, so let's bring all this back home. What's the key takeaway here? Well, it all comes back to our idea of the playpen. It's about building a solid, reliable foundation for your entire investing future.
Now, to be crystal clear, we're not saying blue chips are the only way to invest. They're not the end of the journey, but they are, without a doubt, one of the best starting points you can have. Think of it like building a house. You have to pour a solid, reliable stone foundation before you can start adding the more creative and maybe more speculative upper floors. Blue chips, they are that foundation.
And I just want to leave you with one final provocative question. Today's giants, the Apples, the Googles, the Amazons of the world, they feel completely untouchable, don't they? But as we've seen, every giant can fall. So the real challenge, and honestly the real thrill of long-term investing, is to look at the landscape today and ask yourself,
Which of these titans will still be leading the world in 2040? Thanks for joining us on The Explainer.
So let's talk about small cap stocks. The smaller, up-and-coming companies. Are they the secret key to making huge returns, or are they just a really, really risky gamble? This is one of the biggest debates in the investing world, and in this explainer, we're going to break down both sides of the argument so you can decide for yourself. Okay, so here's the game plan. First, we'll get into the big debate. Then, and you're going to love this, we're actually going to try and talk you out of investing in them. After that, we'll flip it around and look at the huge opportunities, what makes these small companies so powerful, and wrap it all up with a final verdict.
All right, let's dive right in. So why is this even a debate? Well, for years, this idea has been floating around that small stocks just beat the big ones. But when you actually look at the data, it's not quite that simple.
Right. This is the million-dollar question, isn't it? Are small stocks the ticket to big returns? And you know what? The answer isn't a simple yes or no. It actually depends entirely on which slice of history you decide to look at.
Okay, check this out, because this is where it gets really interesting. If you look at this huge 84-year period, it's a slam dunk for small caps, right? They win. But if you look at a more recent window, say from 79 to 2015, the story completely flips. Large caps actually came out ahead. See, it's not so clear-cut. You might be thinking, a couple of percentage points, what's the big deal? Well, the big deal is a little thing called compounding. It's like magic over time. Just look at this number. That 2.2% difference we saw in that first study, over a lifetime, that would turn a simple $1,000 investment into, well, almost $12 million more. That's not just a little extra cash, that's life-changing money. And that, right there, is why this debate matters so much. Okay, before we all get too excited about those big numbers, we need to pump the brakes. Let's talk about the risks, because honestly, small caps are not for everyone. And it's way better to figure that out now before you put a single penny on the line.
So the source gives us a pretty handy checklist here. 4 big red flags. Basically, if you don't have the time to do the homework, or you're not willing to keep a close eye on your investments, if you're the kind of person who's going to lose sleep when the market gets rocky, or, and this is a big one, if you're investing money you actually need for, rent or food, then this part of the market is probably not for you. It's that simple.
And wow, this quote really doesn't pull any punches, does it? Without the right know-how and the right attitude, you're not investing. You're simply lighting your money on fire. It's a pretty intense way to put it, but it's a good reminder that with high potential rewards always comes some serious, serious risk.
All right, so if you've heard all the warnings and you're still here, then you're ready for the fun part. This is where we get into the single biggest advantage that you, as an individual investor, have over the big shot Wall Street funds.
And here it is. This is the big secret. When it comes to small cap stocks, the fact that you're not managing billions of dollars isn't a weakness. It's your superpower. Seriously, you can go places and buy things that the giant mutual funds simply can't.
Let's use this Jack Fund example to see why. Imagine a typical mutual fund, right? It's managing, say, $1.8 billion. To make any real impact on its portfolio, it needs to invest a huge chunk of money, like $180 million. But what if the promising little company it wants to buy is only worth $300 million in total? The fund's purchase would be so massive, it would send the stock price through the roof before it could even finish buying. It basically ruins its own investment. They're too big to get in without making a huge splash. But you can.
And that, right there, is your golden ticket. You can quietly start buying shares in these awesome little companies before the big institutional guys even know they exist. And then, down the road, when they finally discover it, their massive buying power can push the stock price way up, and you're already on board for the ride. But wait, there's more. It's not just about getting in before the big guys. There are some really fundamental, almost mathematical reasons why being small is the secret sauce for explosive growth.
I mean, think about it. It really is just simple math. For a company that's making $10 million in sales, what does it need to do to double? It just needs to find another $10 million. That's tough, for sure, but it's doable. Now, what about a $10 billion giant? It needs to find another $10 billion in new sales. That's a whole different universe of difficulty. See, smaller numbers just have way more room to multiply and grow like crazy.
Okay, and here's another huge piece of the puzzle.
who is actually running the company? In a lot of these small companies, the founders, the managers, they're not just collecting a paycheck. They are major owners. Their own personal fortunes are tied up in the stock. And that changes everything. It means their goals are your goals. They only get rich if the company does well in the long run and the stock price goes up, just like you. They're literally betting on themselves. And when you invest, you're right there betting alongside them. They have skin in the game.
All right, so we've looked at the confusing data, we've stared the scary risks right in the face, and we've uncovered some pretty amazing advantages. Let's bring it all together and figure out what the final verdict is.
So here's the whole thing laid out, side by side. On the risk side of the ledger, you've got higher volatility, you've got to do your homework, and smaller companies can, well, fail. But on the reward side, you've got that history of higher returns, the chance to beat the big funds, explosive growth potential, and managers who are on your team. It's the classic risk versus reward story.
You know, this source leaves us with this great quote: "Fortune favors the bold." If you avoid all risk, you're also avoiding all opportunity. Real success, especially in investing, often comes from taking those smart, calculated risks that other people are too scared to take.
And that really brings us to the final question, and this one isn't for me to answer, it's for you. The big takeaway here isn't that small caps are good or bad, it's about figuring out if they're the right tool for your portfolio, for your goals, and for your personality. So, fortune favors the bold. The real question is your portfolio bold enough?
All right, so let's tackle the big one. How in the world do you find the best stocks to invest in? I mean, it can feel totally overwhelming, right? This is the multi-trillion-dollar question, and today we're going to break it down. Let's get right into it. You know, to really set the stage, you got to look at this classic quote from the legend himself, Peter Lynch. And wow, he is not pulling any punches here. He basically says investing isn't some casino game where you're just hoping for a lucky number. Nope, it's way more like poker. A game of skill, a game of information. But here's the crucial difference. In this poker game, you're actually allowed to look at your cards. In fact, you're supposed to. The wild part, so many people just don't.
And that, right there, is the real challenge, isn't it? I mean, you've got thousands upon thousands of companies out there all screaming for your attention, for your investment. So how do you even begin to look at the cards? How do you sift through all that noise and actually find the winners? Well, that's exactly what we're going to get into right now.
Okay, so here's the game plan. First, we'll talk about just how high the stakes are in this poker game. Then, we're going to expose two super common traps that people fall into all the time. After that, we'll get to the good stuff, a much better way to do it, a business-first philosophy. We'll show you how to start thinking like a business owner, which is a total game changer. And finally, we'll leave you with one critical question to ask yourself before you do anything.
All right. First things first, let's be crystal clear about what's on the line here. This isn't just some casual hobby, you know? Investing is a game with very, very real consequences for your money and your future.
Yeah, the two outcomes here could not be more different. I mean, on one side, you have smart, shrewd decisions that can literally build life-changing wealth. We're talking about funding your retirement, paying for your kids' college, all of it. But on the other side, well, if you invest without a real plan, it's pretty much like shoving your money into a blender. It's just gone. The only thing standing between that money tree and that blender, it's your approach.
Okay, so let's talk about the wrong way to play the game. Because a lot of investors, especially when they're just getting started, get sucked into these strategies that look really fancy and smart on the surface, but are, well, they're just flawed. We're going to look at two of the biggest traps out there. So, trap number one, the chart follower. Oh, you know this person. They're obsessed with all the fancy graphs and squiggly lines trying to predict the future. And here's the thing about those charts. They seem to work perfectly, right up until the second they completely fall apart. Then you've got the pundit follower. This is someone who just listens to the talking heads on TV, you know? They forget that those folks are really in the business of getting good ratings, not making you good returns. See, both of these are just chasing noise. It's reactive, not proactive.
Okay, so if following charts and pundits is like playing poker with a blindfold on, then what's the right way to do it? How do we actually start looking at our cards? Well, the answer is a huge shift in how you think. It's all about looking past the stock ticker and focusing on the actual business behind it. Let's put a name to it: business-focused investing. And really, it's as simple as it sounds. You just stop seeing stocks as these little lottery tickets that jump all over the place. Instead, you start seeing them for what they really are: tiny pieces of ownership in a real, living, breathing company. The goal isn't to guess where the price is going to be next week. The goal is to find a truly great business that you'd be proud to be a part owner of for years and years. You know, this whole philosophy completely changes the questions you start asking. Instead of stressing about what the stock is doing today, you do step 1. You just tune out all that daily noise. Then you get to the most important question of all, step 2. You ask, where is this company going to be in 3 to 5 years? Or hey, even 10 years? Is it growing? Is it creating cool new things? Asking that one question naturally pushes you to step 3. You start acting like a long-term owner, not a short-term gambler. And this right here, this is the heart of the whole strategy. Because we're not just talking about a different technique, we're talking about a complete shift in your identity as an investor. Yeah, the goal here is to go from being a stock buyer, someone who just clicks a button on a ticker symbol, to becoming a business owner, someone who buys a piece of a company because you genuinely believe in what they're building. Honestly, this might be the single most powerful mental shift you can ever make in investing.
Let's really break this down. Let's put these two mindsets head to head. The stock buyer, they are glued to their screen, right? Panicking at every little dip, getting way too excited about every little spike. It's a total roller coaster. The business owner, though, they're doing something completely different. They're actually reading the annual report. They're studying the competition. They're trying to figure out if the CEO knows what they're doing. They're focused on the long-term health of the business because they know, as an owner, that's what really matters in the end.
So the obvious question is, what does a business owner actually look for? If you're going to analyze the business, what are the key things? And the answer isn't some magic number you can just plug into a spreadsheet. It's about looking for deeper, long-term strengths. A real business owner is looking for the stuff that builds a company that lasts. You start asking questions like, does this company have a real competitive advantage? You know, a moat, something like a killer brand or a piece of tech nobody else has that keeps competitors away. You ask, how big is the opportunity here? Is this a market that's growing with lots of room to run? And, so important, you look at the leadership. Is the management team smart? Are they trustworthy? Do they have a vision? These are the things that build real wealth over decades, not just a quick pop in the stock price.
So, we've talked about the big problem, the flawed ways people try to solve it, and this really powerful business-first solution. Now, let's bring it all home and talk about your next move.
Look, if there is just one thing you take away from all this, I hope it's this. Your most powerful investing tool isn't some fancy chart or a complex algorithm. It's your mindset. That simple but profound shift in how you think, that is your single greatest asset. And that brings us right back to where we started with Peter Lynch and that poker game. So the very next time you're about to hit that buy button, I want you to just stop for a second and ask yourself this one question. Am I just betting on the cards here, hoping I get lucky? Or have I actually done the homework and am I confidently buying a piece of a fantastic business that I want to be a part of for the long run? Believe me, your answer to that question will make all the difference.
You know, if you're sick and tired of the constant noise, the day-to-day chatter of the financial world, you have come to the right place. Today, we're going to cut through all of that, just push it aside, and build a really clear, powerful framework for long-term investing. Seriously, this is a set of principles designed to last a lifetime. So, the philosophy we're exploring here actually comes from a group that calls themselves the Motley Fool, and they see their entire approach as a direct challenge, you know? A cannon shot across the bow of the USS Wise, which is what they call the entire traditional financial establishment. It's a totally different way of thinking about where you should put your money.
And this slide, well, it just lays it all out, doesn't it? It really shows the core conflict. On one side, you've got the wise. That's Wall Street. They're obsessed with the short term. They generate these massive fees by constantly trading, and man, they create a lot of noise. But on the other side, you've got the foolish approach. Thinking like you actually own the business for the long haul, focusing on real performance, holding patiently, and just seeking clarity.
So here's our game plan. First, we're going to really define this whole wise versus foolish thing. Then we'll look at the actual cost of short-term thinking, which is huge. After that, we'll get into the 5 core tenets for finding great companies, break them down, and then finally map out how you can put it all into action. Okay, so who exactly are the wise? Well, think about the mainstream financial media, the giant Wall Street firms, and really any advisor who seems to care more about the fees they're charging you than the results they're actually getting. They dominate the conversation, but so often their advice completely misses the mark. Just take a second and look at this number, 80%. That's how many of the pros, the fund managers at the very heart of the wise establishment, actually fail to beat the market over the long run. We're talking 4 out of 5. It really makes you wonder, why are we paying for advice that has an 80% failure rate?
And here it is. This is the root cause. Their whole focus is completely different from yours as a long-term investor. They're asking, what's the market doing today? What did the Fed just announce a minute ago? How's this stock moving this quarter? Look, this short-term obsession, it serves their business model, fees and trading, but it is the absolute opposite of how real, lasting wealth is built.
So let's dig into why this is so bad. Because the short-term approach, it isn't just ineffective, it's actively harmful. Having an itchy trigger finger, driven by the daily market news, has a real mathematical cost that can absolutely decimate your long-term returns.
Let's just talk about the simple math of it all. When you buy a stock, the absolute most you can lose is 100% of your investment. That's it. If the company goes bankrupt, your money goes to zero. It's painful for sure, but it's a finite loss. Your downside is capped. But, and this is the most important part, here's the other side of that equation. Your gains, they have no ceiling. They are literally unlimited. I mean, the Motley Fool has recommended 15 companies that have returned over 1,000%. So think about that. Your losses are capped, but your potential for growth is infinite. This asymmetry is the engine of wealth creation.
This quote it gets right to the heart of it, doesn't it? The biggest mistake you can make isn't picking a few stocks that go down. It's selling a truly great company way too early and missing out on all that massive, unlimited upside. The fear of small losses makes us trade away our future lottery tickets.
Yeah, those huge winners, they're often called multi-baggers. Stocks that just keep growing and growing, returning many times what you first put in. Our minds really struggle with that kind of exponential growth. It's hard to grasp how a company like Starbucks could turn early investors into millionaires. An itch's trigger finger makes you sell way too early, maybe after it doubles, and you miss the next 10, 20, or even 50 times its growth, all while the scissors of commissions and taxes are just taking their cut.
Okay, so if the real goal is to find and just hold on to these great businesses, we're going to need a reliable system to identify them in the first place. And that is exactly where this framework comes in. 5 simple, powerful tenets to help us spot the world's greatest companies, the ones worth holding for decades.
This is the key question, right? With thousands of companies out there, how in the world do you sift through all the noise and actually find the true gems? Well, the answer lies in a structured, business-focused approach. And here they are, the 5 tenets, and they're ranked in order of importance: culture, strategy, financials, safety, and finally, valuation. Now, what's so fascinating is that this order is the exact opposite of how 98% of investors think. Most people start with valuation, the price, and they barely even consider culture at all. This framework flips that completely on its head. All right, let's start our deep dive with the top 3. These are the absolute core of what makes a business that's built to last. These are the things that drive real results over the long run. Tenet number 1, and yep, it's the most important one: culture. And listen, we're not talking about foosball tables or free snacks here. We're talking about the entire ecosystem of the company. How does it treat everyone it touches? You can find clues everywhere. Look at CEO approval ratings on sites like Glassdoor. Do employees feel valued? Do they believe in the mission? Check customer satisfaction scores. Are customers basically evangelists for the product? A great culture creates this virtuous cycle where happy employees lead to happy customers, which, you guessed it, leads to happy shareholders. It's the ultimate leading indicator of success.
Next up, number 2 is strategy. I mean, every business has competitors, right? So what is this company's plan to win? You're looking for durable competitive advantages. Is it a powerful brand that people just trust, like Apple? Does it have a network effect where the service gets better as more people use it, like with Meta? Does it have some kind of secret sauce, a patent or technology that's just really hard to replicate? A great company isn't just surviving, it's actively finding ways to widen the moat around its castle year after year.
So once you have a great culture and a winning strategy, you got to check the engine room. Tenet number 3 is financials. Think of a strong balance sheet as the company's immune system. A business that's drowning in debt is incredibly vulnerable. A small economic downturn can become a full-blown crisis. But a company with lots of cash and very little debt, it has freedom. The freedom to buy a competitor, to invest heavily in research during a recession, to survive the unexpected. This financial strength is what fuels the culture and the strategy for decades to come.
Okay, now we can move to the final two tenets. After we've confirmed that the business itself is excellent, then we turn our attention to the potential risks and finally to the price tag the market has decided to put on it.
Tenet 4 is safety, which honestly is just an optimistic way of talking about risk. Since we plan to hold these companies for at least 5 years, we have to think about what could possibly go wrong. This isn't about being pessimistic, it's about being prepared. Great companies are resilient. We ask these tough questions not to find a business with zero risk, because that doesn't exist, but to find one that has the strength and the adaptability to handle whatever challenges the future decides to throw at it. And at last, we arrive at valuation. Now, of course, the price matters, but it's number 5 for a really important reason. A mediocre business is a bad investment at any price, while a truly great one can justify a price that might seem high today. You see, the price tag is just a snapshot in time. The quality of the business, that's the long-running movie. If you get the business right, the starting price becomes less and less important as that story unfolds over 10, 15, or even 20 years.
This quote just says it all perfectly. Imagine you could hop in a time machine and go back to 1998 to buy Starbucks stock. Would it really matter to you today if you had paid $7.25 a share or $9.15 a share? Of course not. When you're dealing with a world-changing company, being a few % off on your entry price becomes a rounding error over time. Getting the business right is what really counts. So let's bring all this home. We've torn down that short-term, fee-driven approach of the whys, and we've built up a patient, business-focused framework in its place. So now, how do you actually use it?
Okay, here are the crucial points to remember. First, shift your time frame from days to decades. Second, focus on the quality and the culture of the business, not the daily market chatter. Next, have the courage to just let your winning investments keep on growing. Your goal is to find these exceptional companies and, ideally, add your positions over time. And never, ever forget, it is so much better to buy a wonderful company at a fair price than a fair company at a wonderful price.
And I'll leave you with this one final thought. Just look around at your own life. Which companies do you interact with and really admire? Which ones have a fantastic culture and a winning strategy that you can see as a customer? Your own experience is often the very best place to start looking for the next everlasting investment.
When you're digging into a company, what's the first thing you look at? Is it the revenue? Profit margins? Maybe the debt-to-equity ratio? Yeah, those are all absolutely crucial, of course. But what if I told you that a company's most powerful, most lasting advantage isn't even on the balance sheet? Well, that's what we're talking about today. We are going way beyond the spreadsheet to explore the one factor that can truly supercharge an investment for the long haul. It's culture.
And this quote from the legendary investor Chuck Royce just nails it. While pretty much everyone is sifting through the exact same financial data, the real, sustainable edge is hiding in these qualitative areas. And these aren't just some fluffy, feel-good extras. Royce calls them multipliers on returns for a very good reason. A great culture doesn't just add to a company's success, it literally amplifies it, creating this durable advantage that the numbers alone could never predict.
Okay, so here's our game plan. First, we're going to unpack this idea of the unseen multiplier. Then, we'll see how it all starts right from the CEO's office and how it trickles down to every single employee. We'll look at it in action with a couple of real-world case studies, and then, the best part, we're going to arm you with a practical checklist so you can spot these cultural powerhouses for yourself. All right, let's kick things off with Section 1, the unseen multiplier. You know, the biggest challenge for any investor is that financial data has become a commodity. Everybody has access to it, which means, a lot of the time, everyone comes to the same conclusions. The real edge, the true alpha, is found in what you might call the vague gray areas, those strengths that you just can't plug into a spreadsheet. And the most powerful of these is, you guessed it, corporate culture.
So what are we really talking about when we say culture? Well, it's really the sum of all the relationships a company has. How does it treat its customers, its community, its shareholders, and, maybe most importantly, how do its own people treat each other? In today's world, where everything is so transparent and connected, it's getting harder and harder for a bad culture to hide. And for us as investors, that means it's more important than ever to find the companies that are genuinely trying to do right by everyone they touch.
So, where does a great culture even come from? It definitely doesn't happen by accident. It's built on purpose, and the architect is almost always the company's leadership. That's why our investigation always has to start right at the top, with the CEO. They're our first and biggest clue.
And here's a really powerful signal to look for: a founder who stays on as CEO long after the IPO. I mean, think about it. At that point, they've probably already made more money than they could ever spend. Their decision to stick around? It's not just about another paycheck, it's about a deep, authentic passion for the thing they built from scratch. That kind of purpose is contagious and is the foundation of a really strong culture.
And we've seen this play out time and time again with some of the most successful companies out there. Take Mark Zuckerberg. After Facebook's IPO, which was rocky to say the least, public opinion was not great. But inside the company, people were totally fired up because of his clear, massive vision to connect the entire world. It's that same pattern you see with Jeff Bezos at Amazon or Warren Buffett at Berkshire, and it's exactly why Howard Schultz's return to Starbucks in 2008 was so important. He came back to reignite that core cultural flame.
Okay, so leadership is huge. We get it. But what about the employees? How do we know if that vision from the top is actually making things better on the ground floor? And for us as investors, here's the real question. Does a happy, engaged workforce actually translate to a better stock price?
Let's just cut right to the chase. Does all this talk about employee satisfaction and having a purpose-driven job, does it actually have any real, measurable impact on a company's stock? Is this a financial factor we should be looking at, or is it just a nice to have?
Well, the data is in, and it gives us a clear, resounding yes. This isn't just a theory anymore. By analyzing mountains of anonymous employee data from sites like Glassdoor, researchers have found a direct, measurable connection. How employees feel about where they work is a powerful predictor of how that company's stock will perform. It's pretty incredible.
And here's the proof in black and white. This research shows that companies that get rave reviews from their own employees consistently tend to outperform the S&P 500. But look at the other side. The companies at the bottom of those ratings, the ones with unhappy, disengaged workers, they've been shown to significantly underperform the market. I mean, the gap is huge. So the takeaway is this: employee sentiment is a powerful leading indicator of where a company's stock is headed.
This, right here, this is what you're looking for. This is the gold standard. When you find employees who actually feel this way, it tells you there's a strong two-way street. The company is investing in its people, and in return, the people are investing their passion and their energy right back into the company. It creates this amazing virtuous cycle of high retention and deep institutional knowledge, which is just an incredible long-term asset.
All right, so we've covered the theory and we've seen the data. Now let's see what this actually looks like out in the real world. We're going to check out two very different companies, Google and Chipotle, to see how they each built a legendary culture that drives incredible success.
So our two case studies are Google and Chipotle. And on the surface, you couldn't find two more different businesses. Google's culture is all about its core competency, data. Chipotle, on the other hand, built its entire culture around a core value, integrity. Let's dig into how each one makes it work.
So Google's mission is to organize the world's information, right? Well, they apply that exact same data-driven mindset internally. They basically turn their superpower inward. Under the leadership of Laszlo Bock, their longtime head of people operations, they built a system that measures everything. They're constantly surveying their massive workforce to really understand what motivates people, using their own tech to maintain that personal connection at scale. For Google, data isn't just their product, it's literally in their cultural DNA.
Now, let's switch gears to Chipotle. Their mission is so simple and so powerful. Food with integrity. And their whole culture is designed to deliver on that promise. They are obsessed with developing their talent from within. Their system is literally set up so that someone who starts on the line just warming tortillas can see a genuine path to a high-level management job. And that creates this incredible sense of ownership and opportunity, which leads to employee retention rates that just blow the rest of the industry away.
Okay, this brings us to our final and, I think, most important section. We've seen why culture matters. We've seen what it looks like, so now how can you apply this to your own research? Let's build a practical toolkit that you can start using today to analyze a company's culture.
So where do you actually find all this info? It's way more accessible than you might think. First up, a company's proxy statement, that's Form 14A, is going to tell you all about who owns the company and how much the top execs are getting paid. Second, SEC.gov is where you can look up Form 4 filings to see if insiders are buying or selling stock. Third, Glassdoor.com is your go-to for raw, unfiltered feedback from employees. And finally, don't sleep on the company's own website for its mission, values, and history.
Using those sources, we end up put together our master tool, the culture checklist. Now, this isn't about finding a perfect company, because that doesn't exist. It's about looking for a pattern.
This list distills everything we've talked about into 10 concrete things to look for.
All right, let's run through it. Is a founder still involved? That signals passion. Do insiders own over 5% of the stock? That means they've got serious skin in the game. Is executive pay fair and not totally outrageous? That tells you if leadership is aligned with shareholders. Okay, now for the inside view. Is the CEO's approval over 80% on Glassdoor? And would more than 60% of employees recommend working there to a friend? Those are huge. Look for a cool employee benefit that makes you say, man, I wish I had that. Find real evidence of customer love, not just marketing fluff. Is their purpose clear? Is there diversity in leadership? And finally, can they attract and keep the best people? Look, no company is going to be perfect, but a high score here points to a serious competitive advantage.
So, we'll leave you with this question. From now on, when you're analyzing a potential investment, don't just stop at the numbers. The balance sheet, that tells you where a company has been. But its culture, the passion of its leaders, and the engagement of its people, that's what tells you where it's going.
All right, let's talk strategy. Specifically, how to spot a winning company. You know, it's one of the most important skills you can have as an investor, being able to tell the difference between a company that's built to last and one that's just, well, gonna fizzle out. So how do we find those winners? So here it is, the big question, right? How do the best investors, the Warren Buffetts of the world, seem to just know which companies are going to be huge long before anyone else catches on? Is it some kind of secret formula? Do they have a crystal ball? What's the deal? Well, the answer is actually a lot simpler than you might think. It's not magic. It all comes down to strategy. It's about having a clear, simple framework for looking at a company and understanding its real advantages. And that's exactly what we're going to build together today. Okay, so here's our plan. We're going to look at 3 things. First, what I think is the #1 factor, which is pricing power. Then we'll talk about the runway, or market opportunity. And third, the power of habit, customer loyalty. And at the end, we'll wrap it all up into a simple investor toolkit for you. All right, let's dive into the first one. And honestly, this is the big one, pricing power. Warren Buffett himself has said this is pretty much the single most important thing he looks for in a business. Think of it as the compounding machine, the engine that really drives the best investments out there. So what are we actually talking about when we say pricing power? Well, it's pretty simple, really. It's the ability for a company to raise its prices year after year without losing its customers. And this isn't something that just happens, you know? It's built on a super strong brand, or maybe a patent, or a network that's just impossible to compete with. Just think about companies like Coca-Cola or American Express, Buffett's favorites. They're legendary because for decades, they've been able to nudge their prices up, and that just compounds their value over time. And this is where it gets really crucial, especially in a world with inflation. Think about it. Cash is always losing a tiny bit of its power. The real test for a company is, can they raise their prices just a little bit faster than inflation? Let's take that coffee example. If your $3 coffee suddenly costs $3.09 next year, would you even blink? Probably not. But that tiny, tiny increase, when you multiply it by millions of coffees a day, that's a game changer. That's what separates the good from the great. So how can you spot this for yourself? It's actually a pretty simple test. Just ask yourself, what do I pay for that I would probably keep paying for, even if the price went up a bit? Take a look at Netflix. There's a ton of competition, but they know exactly what you watch, so their recommendations get better and better, making you feel like you can't live without it. Or how about Amazon Prime? I mean, seriously, would you really cancel your Prime membership if it cost a few more bucks a year? And Costco is a great one. The experience is so unique that people happily pay the membership fee, and Costco can raise that fee over time. That's pricing power. Okay, moving on to our second big idea, the runway, or market opportunity. It's not enough for a company to be awesome at what it does right now. It needs room to grow. I love this idea of a runway. How much space does it have to take off? Because even the best company in the world is going to stall out if its market is tiny. So you've got to ask, is the pie they're in growing, or is it shrinking? This quote right here is the perfect example of what not to do. It's a classic cautionary tale. You can find a fantastic company, great product, great people, but if they run out of road, it's a dead-end investment. The person who wrote this just didn't stop to think about the total size of the market. I mean, how many people actually go snowboarding? It's a niche. And if your market is a niche, eventually your growth is going to hit a ceiling. But here's the flip side. A really smart company can build a longer runway for itself. I remember people joking that there was a Starbucks on every corner, that they had nowhere else to go. But look at what they actually did. They went global, big time. They added drive-thrus everywhere, which was a genius move. Then they started selling their coffee in every grocery store you can imagine, and they licensed their brand out. See, the management didn't just see themselves as a coffee shop. They saw a massive global opportunity, and they went for it. All right, that brings us to our third and final piece of the puzzle, the habit. We're talking about customer loyalty. And this is one of those things that sounds simple, but it is so, so powerful. It's all about turning a single purchase into a regular habit, creating a stream of revenue you can count on. This is what turns a good company into an absolute cash machine. I absolutely love this quote from Bernard Baruch. It just perfectly nails the concept. He said to find companies whose products you buy, use up, throw away, and then you have to buy it again within a month? I mean, how simple is that? That's the core of a recurring revenue business, and for an investor, that is pure gold. And you know what? The best research tool you have for finding these companies is probably your own credit card statement. Seriously, we are all just creatures of habit. So take a look. Where does your money go like clockwork every single month? Chances are the companies you find there are some of the most solid, long-lasting businesses on the planet. Okay, so there you have it, our three core ideas: pricing power, a big market opportunity, and customer loyalty. Now let's pull all this together and forge it into a toolkit that you can actually use. Let's turn this theory into action. So what does the perfect company look like through this lens? Well, it's the trifecta, right? It's a company that has pricing power, it's playing in a huge and growing market, and it has customers who don't just come back, they come back enthusiastically, over and over again. Now, figuring all this out is both an art and a science. The science part is digging into the numbers, reading the annual report on their website. But the art is just as crucial. Go on YouTube and watch interviews with the CEO. Get a feel for them. Read the customer ratings on Amazon. That's where you'll find clues about loyalty. And honestly, just talk to people. If your friends are all excited about some new company coming to town, pay attention. That's real data. So if we were to put on an expert's hat, what would they be looking for? Well, they're looking for pricing power, and they check for that by looking at something called gross margins, basically the profit they make on each thing they sell. Are those margins going up over time? They're looking for those repeat purchases we talked about, and a market with a long, long runway. But they also look at a couple of other things, like, is management smart about where they spend their money? And is this company basically creating or owning its own little corner of the world? Okay, let's boil it all down to one final checklist. This is what you're looking for. 1, clear evidence of pricing power, and you can see that in a nice, stable, or even growing gross margin. 2, proof of repeat purchases, that habit loop. 3, a brand flock. I love that term. Not just customers, but fans. 4, a market that's got plenty of room to grow. And finally, a management team that actually has a clear plan and can tell you what it is. So now the ball is in your court. I want you to take this framework, this 3-part test, and just look around at your own life. Think about the companies you deal with every single day. Which ones pass the test? Which ones have that pricing power, that huge runway, and have turned you into a loyal, repeat customer? Think about it, because the answer could be pointing you straight to your next great investment.
Welcome to The Explainer. Today, we're going to break down how you can analyze a company's financial statements to find those incredible long-term investments. We're going to give you the tools you need to start thinking like you own the business, not like you're just trading a stock.
Let's kick things off with this classic business joke. And it might get a chuckle, but honestly, it perfectly captures the big challenge we're talking about today. It's so easy to get swept up in a company that's growing like crazy, but if that growth isn't actually profitable, well, it's just a fast lane to going broke. Just think back to the dot-com bust. It was a brutal lesson for countless companies that made this exact same mistake.
All right, so here's the game plan. We're going to start with the #1 secret to finding stocks that absolutely take off. Then we're going to add some really critical filters to help you separate the real winners from the flashes in the pan. We'll also get into how you can judge the people running the show, where to dig up all this info, and we'll wrap it all up with a super practical checklist you can start using immediately.
Okay, so what is the secret to finding a multi-bagger? That's the term for a stock that returns 20, 30, maybe even 40 times what you put in. The kind of investment that can literally change your family's financial future. What's the one thing that all these incredible success stories have in common?
Look, it's actually not that complicated, but it is so important. When you study the absolute best-performing stocks over the last couple of decades, one thing stands out above everything else: incredible top-line sales growth. You're just not going to find a stock that went up 20-fold that was just kind of chugging along at 4 or 5% a year. You need a business with massive, unstoppable demand for its stuff.
And this slide just nails that point perfectly. I mean, look at legendary companies like Starbucks and Whole Foods. Their stocks gave investors these incredible 15 to 25% returns year after year for decades. But here's the kicker. Their sales actually grew even faster than that. That tells you that the public's hunger for their coffee and their groceries was even more powerful than the amazing value they were creating for shareholders. That's the engine you want to find. And man, this example just brilliantly illustrates why you've got to look at the numbers, not the noise from the headlines. Remember when Facebook first went public? The market completely panicked. It punished the stock because everyone thought their move to mobile was slow and clumsy. But the financial statements? They were telling a completely different story. Top-line sales weren't just growing, they were starting to accelerate as that mobile strategy finally took hold. The numbers were screaming the truth long before the stock price ever caught on.
But, and this is a huge but, as we saw with the dot-coms, sales growth all by itself can be a recipe for total disaster. High growth with no profit is just a really, really efficient way to set a pile of cash on fire. So you've found a fast-growing company. Now what? You need a second absolutely crucial ingredient to make sure it's a real winner.
Okay, so here's the deal. You have to pair that high growth with high profitability. And the best single way to measure that is a metric called return on equity, or ROE. Put simply, it answers this question. For every single dollar shareholders have put into the business, how much profit is the company spitting out each year? It's just a powerful, powerful way to see how good a business is at making money.
And here's your benchmark, your starting line. You want to see a return on equity of at least 10%. That's about average for a company in the US, so think of it as the bare minimum. But really, you're hunting for the elite ones, the businesses that are consistently cranking out returns of 15%, 20%, or even higher. That, my friends, is the sign of a truly special business.
Now, a company with amazing growth and a killer ROE, that's a fantastic find. But you got to remember, those numbers don't just appear out of thin air. They're the direct result of a smart, disciplined management team making intelligent decisions about where to invest the company's cash. It's called capital allocation, and it's one of the most overlooked but most critical parts of your whole analysis.
So as a part owner, you need to put on your detective hat and ask these 4 key questions. Why are they paying a dividend? Is it because they're a mature, disciplined company, or have they just plain run out of good ideas to grow the business? Are they being smart and buying back stock when it's cheap, or are they just mindlessly doing it on autopilot? Are they making small, clever acquisitions that actually add value, or are they trying these risky empire-building mergers? And finally, how are they using debt? Is it a strategic weapon or a sign of weakness?
And this quote right here, it just nails it. The absolute gold standard is a company so profitable, it doesn't even need outside money to grow. Think about the early days of Buffalo Wild Wings or Chipotle. While most restaurant chains have to take on tons of debt to open new stores, these guys were so profitable on a per-store basis that they could fund their entire expansion from their own profits. That is a massive, flashing sign of a powerful business.
So, let's do a quick recap. We know we're on the hunt for that perfect trio: high growth, high profitability, and smart management. That's the what. But what about the where? I mean, where do you actually find all this information? Well, it's time to open up the toolkit.
It all comes down to 3 key financial statements. Public companies have to release them every quarter in a filing called a 10Q and every year in a 10K. And you can find these for free on any company's investor relations website. Seriously, this is your owner's manual. First up, the income statement. This one's pretty easy to get your head around. It just shows you the company's sales, or revenue, and all its expenses over a specific time period. This is where you'll track that all-important sales growth. And just as important, you also want to see if their profit margins are going up, which means profits are growing even faster than their sales.
Second, you've got the balance sheet. Think of it like a financial snapshot, a single photo of the company's health at one specific moment in time. It shows you everything the company owns, its assets, and everything it owns, its liabilities. Here you're just checking to see if they have a strong financial position with plenty of cash to grow and that their debt levels are reasonable.
And third, and this might be the most important one of all, is the cash flow statement. This is where the truth comes out. It cuts through all the accounting jargon to show you how much actual cash is flowing into and out of the business. This is where you can figure out a metric that Warren Buffett absolutely loves called owner earnings. It's basically the real spendable cash a company produces for its owners. It helps you see if the company is a true cash-generating machine.
Okay, we have covered a ton of ground. We've talked about growth, profitability, management, and a big 3 financial statements. So now, let's boil it all down into one simple, powerful checklist that you can use for your own analysis.
Here you go. This is your 6-point guide. Are sales growing? Great. But even better, is that growth accelerating? Are profit margins getting wider? Does the company earn high returns with a smart amount of debt? Does the balance sheet look healthy? And is its real cash flow, its owner earnings, poised to keep growing? See, it's not just about one number. It's about seeing the complete picture of a healthy, accelerating business.
So there you have it. You now have the exact framework that professional investors use to find the best businesses in the world. The tools are officially in your hands. So really, the only question left is, which company's story are you going to uncover first?
So before you decide to put your hard-earned money to work in the stock market, you've got to run a sort of pre-flight check. Think of this as your guide to investor safety, a way to really understand the risks before your portfolio takes off.
Okay, let's get one thing straight right from the get-go. There is absolutely no such thing as a risk-free stock. It just doesn't exist. If anyone ever, and I mean ever, promises you guaranteed returns with zero risk, that is a huge red flag. Every single investment has some risk. Our job isn't to try and eliminate it, because that's impossible. It's to understand it.
So here's our flight plan for today. First, we're going to accept that risk is just part of the journey. Then we'll ask maybe the most important question of all: who's flying the plane? After that, we'll scan the horizon for any industry disruption and check if our investment has gotten, too big to maneuver. We'll also get ready for the inevitable market turbulence before we land with a really practical safety checklist that you can use yourself.
Right, our first section here is all about getting into the right mindset. Because, before we can even begin to talk about safety, we have to be totally clear about what's actually at stake.
So when we talk about safety in investing, what do we really mean? It's not about trying to get rid of all risk. No, it's about one thing and one thing only: protecting your initial capital from being lost forever. That is priority number 1. Everything else, it comes second.
Now, for what might be one of the most important checks on our list, and it all comes down to a really simple but powerful question: who is flying the plane?
I want you to imagine this. Every stock you own is like a seat you bought on an airplane. As an investor, you're the passenger. You are not at the controls. The company's CEO, their leadership team, they're your pilots. So your job is to decide just how confident you are that they can get you to your destination safely and on time.
And you got to remember, you're in this for the long haul with this pilot. You don't just get to swap him out mid-flight. I mean, think about the kind of confidence investors had in leaders like Howard Schultz at Starbucks or Mark Zuckerberg at Meta. A huge part of why people invested was their faith in the pilot's vision and their ability to get the job done.
But here is the million-dollar question for any long-term investor. What happens when that star pilot decides to retire? Who's the co-pilot, ready and able to take the controls? A company's plan for succession is a massive and, frankly, an often overlooked risk. Just look at these 2 examples. They show you everything you need to know. At Costco, when the founder Jim Sinegal handed the reins over to Craig Jelinek, it was a textbook smooth transition. The plane barely wobbled. Now compare that with Starbucks. Howard Schultz's first time leaving led to 5 years of pretty bad performance, right up until he came back. It's a perfect illustration of the night and day difference a solid plan can make.
Okay, so we've checked out the cockpit. Now it's time to look out the window. Our next safety check is all about spotting and navigating potential storms on the horizon, those big industry disruptions.
This is what's known as a platform shift. The classic example here is bookstores. For decades, the platform was a physical store, right? You go to Barnes & Noble. Then Amazon showed up and shifted the entire platform to online ordering and home delivery. When a fundamental shift like that happens, the threat to the old way of doing things is just immense.
In this kind of thing, it happens over and over again. Just think about the massive shift from desktop computers to mobile phones. That single change created a whole new generation of winners, and it pretty much condemned the companies that couldn't adapt. So as an investor doing your safety check, you have to constantly be asking, what major shifts are happening right now? And is my company on the right side of that change?
All right. Our 4th check highlights a risk that doesn't come from a competitor, but kind of ironically, from a company's own success. It's what you might call the law of large numbers, or as we're going to call it, the aircraft carrier problem.
This quote just says it all, doesn't it? The bigger a company gets, the harder it is for it to be nimble.
An aircraft carrier is unbelievably powerful, but it can't turn on a dime. And it's the same thing with a massive company. It often has to work incredibly hard just to get market average growth.
And man, history is just filled with examples of this. Just think back to the year 2000. Companies like Microsoft, Intel, and Cisco, they were the absolute titans. They had the most cash, the best talent. They seemed destined to just dominate forever. And yet, over the next 10 to 15 years, they were pretty mediocre investments because smaller, nimbler companies were creating whole new industries around them.
All right, so we've checked the leadership, we've looked at the external environment, and we've considered the size of the company. The final, and you could argue the most critical safety check, well, it involves looking in the mirror. It's all about your plan for when the market turbulence inevitably hits.
Okay, let's just get grounded in some facts here, because market turbulence isn't an if, it's a when. History shows us the market goes through a 10% correction on average every 3 or 4 years. This isn't a bug in the system, it's a feature. It's just how markets work.
And the drops can get worse. A 20% decline, what we call a bear market, that happens about once a decade.
And then you have the big one, a major crash of 30% or more. That's something you should expect to see at least once or twice in your investing lifetime. See, these aren't rare events. They are a predictable part of the journey.
So knowing these drops are coming, the most critical question you can ask yourself has nothing to do with your stocks. It has everything to do with your own psychology. What are you going to do when your portfolio is down big? Are you going to panic and sell everything at the absolute worst possible time? Or will you have the mental strength to stick with your plan, or maybe even see it as a chance to invest more? Your temperament is your final line of defense.
Okay, let's pull all of these ideas together into one final pre-flight briefing. This is the practical checklist you can actually use to go and assess the safety of your own investments.
So here are the key questions you got to ask. First, is the company looking ahead and anticipating industry changes? Second, is there a deep bench of talented managers ready for succession? Third, is the company finding profitable ways to reinvest its cash, proving it can still grow? Fourth, does it have a diverse customer base, so it's not totally vulnerable if it loses one big client? And finally, is the leadership aware of potential regulatory threats and are they ready for them?
And that really brings us to our final thought. The turbulence will hit. Market downturns are a certainty. The only thing we don't know is how you'll react. So after running through this safety checklist and preparing your mind, the question is, are you going to be the investor who sells in a panic or the one who is confident and ready to act?
Welcome to The Explainer. You know, it's so easy to get caught up in all that short-term noise from Wall Street, right? Well, today, we're going to break down a really powerful framework from the Motley Fool. It's going to teach you how to see past all those daily ups and downs and start looking at companies like a true long-term owner.
So here's what we've got on tap. First, we're going to talk about a huge mindset shift. Then we'll get into the nitty-gritty of the numbers that really matter. We'll explore how to spot amazing opportunities when everyone else is panicking. And finally, we'll wrap it all up with a complete toolkit that could totally change how you value a company.
All right, first things first. We have to completely change the question we ask ourselves when we look at a stock. Seriously, this is the foundation for everything else we're going to talk about. It's about moving from a trader's mindset to an owner's mindset.
Now, when most people on Wall Street ask this question, they're thinking about what? The next few weeks, the next few months maybe? They're looking for a quick pop, a fast gain, and by doing that, they often miss the much, much bigger picture.
This slide just nails the difference, doesn't it? On one side, you've got the trader. Hey, a 20% gain is nothing to sneeze at, right? But on the other side, you have an investor, an owner. They're asking a totally different question. They're looking for something that could fundamentally change their financial future. It's a completely different game, and it all starts by asking a bigger, bolder question.
So how do we actually start thinking like that long-term owner? Well, the very first step is a big one. You have to learn to ignore the headline earnings number that gets splashed all over the news every quarter. We've got to pop the hood and find out where the real cash is. And instead of those reported earnings, we focus on something called owner earnings. Think of this as the pure, unfiltered cash a business is generating. You start with the official profit, the net income. Then you add back stuff like depreciation and amortization. Those are accounting charges, not real cash that left the building. And then, this is the really important part, you subtract the money the company had to spend just to keep the business running as is. What you have left is the real, honest-to-goodness cash profit for the owners.
And you know what?
This number is often wildly different from the adjusted earnings you see in a press release. It's just more honest. It cuts through all the accounting gymnastics and answers one simple, powerful question. How much actual cash is this business putting into the pockets of the people who own it? Okay, so now that we're focused on real cash, the next step is to stretch out our timeline. I mean, really stretch it out. We're getting away from thinking about the next quarter and focusing on the next 5 years. And it's kind of funny because by ignoring the short term, you can unlock so much more in the long term.
The goal here isn't to make a quick buck next month. It's about finding businesses that can grow their cash flow at a rate that just blows the market's current expectations out of the water. We're on the hunt for the true compounders.
And here is the secret sauce. The market is consistently bad at valuing true long-term growth. Just like this quote says, the idea that a company can keep growing at a high rate for decades, well, it just seems absurd to people stuck in that short-term mindset. And right there, that's your opportunity.
I mean, just think about Starbucks back in the 90s. If you wanted to invest, you had to pay what seemed like a crazy high price, sometimes 100 times its earnings. That's way, way above the market average. Short-term thinkers probably thought you were nuts, but the long-term investors, they saw a growth machine that could keep running for years and years, and boy were they rewarded for seeing what others missed.
Now, when you adopt this long-term view, you get a kind of psychological superpower, especially when the market gets jumpy and all the headlines are negative. Think about it. When the media is screaming about some short-term problem, it's like a fog rolls in and hides the long-term potential. For the investor who's done their homework, that's not a signal to panic and sell. No way. That's the signal to get interested. That's when you can buy a fantastic business at a discount, while everyone else is running for the hills.
Oh, and Facebook's early days are just a perfect case study. After all the IPO hype, the stock totally cratered. Why? A ton of bad news about its mobile strategy. But what did the long-term investors see? They saw Mark Zuckerberg making these incredibly tough, expensive decisions, like retraining his entire team for mobile first. He was thinking 10 years ahead while Wall Street was obsessed with the next quarter. That gap, that disconnect, that was the opportunity.
Okay, so we've got the philosophy down. But how do you actually turn all these ideas into a process you can use again and again? Well, let's build out the toolkit.
It all starts with a quality check. Before you even think about opening a spreadsheet, you have to ask the big questions. Does this company have a great culture? Are its finances solid? Is its long-term strategy something you actually believe in? And is it a reasonably safe bet? Only if the answers are yes do we even bother moving forward. So, if and only if the company passes that first quality screen, then you move on to this specific 4-step valuation checklist. You do a common sense check on its growth rates, you confirm it's actually generating cash with positive owner earnings, and then the final test. Can its expected growth beat the market? It's a really disciplined filter, and it's designed to find the real winners.
All right, we've arrived at the final section. And honestly, this might just be the most important part of all. Because you can have the most perfect, brilliant, analytical system in the world, but if you don't have the right mindset to stick with it when things get scary, it's completely useless.
And who better to learn from than Warren Buffett, right? His incredible success isn't just because he's a genius at math. It's his temperament. It's his unbelievable ability to stay calm and rational when everyone else is freaking out, and to stay patient for decades. That right there is the real superpower we all need to work on.
So how do you actually enforce that kind of discipline in your own life? Well, the author of this framework has a simple but incredibly powerful rule. Any stock he buys, he commits, right up front, to not selling it for at least 5 years. No exceptions.
What a rule like that does is it forces you to think like an owner, not like someone who's just renting a stock for a little while. It basically short-circuits that emotional knee-jerk decision-making. It makes you learn from your choices, and most importantly, it gives your best ideas, your biggest winners, the time they need to really work their magic and compound.
So when you boil it all down, whether you use this exact system or you build your own, the core ideas are the same. A solid framework gives you the structure to make good decisions, but it's patience that gives you the time you need for those good decisions to actually pay off. And that really leaves us with one final question to think about for our own investing. Finding the right companies, that's only half the battle. The real challenge, the part that really matters, is developing the right temperament. The math is easy, the patience is hard. So do you have what it takes?
Today, we're diving into an investing philosophy that basically takes the most common stock market advice and just throws it right out the window. This is a strategy that isn't just about playing the game, it's about finding the companies that are changing the rules for everyone.
You've heard all of these, right? They're like Wall Street's greatest hits. Little rhymes that sound super wise and get passed down like gospel. But what if I told you that following them is the exact reason most people miss out on those truly life-changing investments?
That's right, the Motley Fool, which is the source for this whole explainer. They've got a name for these little sayings. They call them falsisms. Ideas that sound true on the surface, but in reality, they often lead you in the wrong direction and away from the companies that are genuinely building the future.
So what's the alternative? Well, it's a philosophy called rule breaker investing. And this is the approach that has helped pinpoint some of the biggest winners of our time. We're talking Amazon, Netflix, Priceline, way before they were the household names they are today. It's all about finding the disruptors, the innovators, the companies that are totally rewriting the playbook.
Okay, so here's the game plan for how we're going to break this all down. First, we're going to challenge those old rules. Then, we'll get crystal clear on what a rule breaker is. After that, it's all tactics, the 6 signs to look for, how these companies evolve, how to spot the imposters, and finally, the proof that this whole thing actually works.
Look, if you want to find companies that could return 500%, or hey, even 5,000%, you've got to think differently. Those cute little rhymes and old sayings, they're just not going to get you there. They're designed for finding average, maybe stable companies, not the dynamic, world-changing businesses that can produce absolutely explosive growth.
So what are we actually looking for here? Because it's not just about finding a new company or some hot startup. A real rule breaker has a very specific DNA, a certain set of traits that makes it completely different from everything else out there.
So here's the core of it. A rule breaker is basically a force of nature. It doesn't just work inside an industry, it completely reshapes it. These are the companies that create something that makes you go, how did we ever live without this? And, as it turns out, changing the world can be a really, really profitable business.
I love this quote from Shakespeare because it just perfectly captures what a rule breaker is. Their arrival is never quiet. They make a huge impact right from the start. They show up with a vision that says, hey, what you have now, it's not good enough. And then they go out and prove.
This brings us to a super simple but really powerful way to spot a true rule breaker. Just ask yourself this one question. If this company just disappeared tomorrow, would anyone notice? I mean, would people actually care? The answer to that tells you almost everything you need to know.
And the difference is just night and day. If a real rule breaker like Google vanished, it would cause genuine, widespread chaos and distress. But if a faker breaker, a company that just looks innovative on the surface, disappeared, honestly, the world would barely even blink. That's the difference.
All right, let's get into the framework. How do you actually spot these companies out in the wild? Well, this philosophy gives you a kind of field guide with 6 specific signs to look for. Now, not every great company is going to check all 6 boxes, but the ones that do, they deserve some serious attention.
So here are the 6 signs in a nutshell. We're on the lookout for leaders in new industries with amazing management, a real sustainable edge, and a powerful brand. And then you've got these last 2, which are fascinating and totally counterintuitive. The stock has already done well, and the old guard thinks it's overvalued. We're going to dig into all of these.
Let's start with the foundation, signs 1 and 2. First, the company has to be a leader, the top dog in an important and emerging industry. Think back to the dawn of e-commerce or streaming. And second, you need visionary leadership. The people in charge have to have a bold, clear picture of the future and the brains to actually make it happen.
Next up, we look for the company's moat, basically its defenses. What advantages does it have that are sustainable? We're talking patents, network effects, special tech, something that competitors can't just go out and copy. And fourth, a strong brand. People need to know the company, trust it, and feel some kind of connection to it.
Okay, now for the 2 signs that scare most investors off. Sign number 5 is that the stock has already gone up a lot. I know, conventional wisdom screams buy low, but rule breakers are all about the idea that winners tend to keep on winning. And sign number 6, the establishment is yelling that it's overvalued. When you hear traditional analysts say a stock is way too expensive, that's often a huge sign that they're just not grasping the massive opportunity at play.
But here's the thing. A company doesn't just stay a rule breaker forever. The ultimate goal of every usurper is to become the ruler. The successful ones, they evolve. They follow this really distinct life cycle.
In this journey, it's a total battlefield. It starts as a breaker, the disruptor. Then it enters the most dangerous phase, what's called the tweener stage. This is where all the copycats show up and try to steal their idea. But if they can survive that fight, they graduate to become a maker, an established leader that is now writing the rules for the industry it created. Okay, this is so important. Not every company that's growing fast is a true rule breaker. A lot of them are just fakers. And knowing how to tell the difference between a temporary spark and a raging wildfire is probably one of the most critical skills for this kind of investing.
Think about it like this. A company that sells generators might see a huge spike in sales after a big hurricane. Sure, that's rapid growth, but it's temporary. It's situational. It doesn't mean that company is fundamentally changing the energy industry. A real rule breaker's growth comes from sustainable innovation, not just random one-off events.
And this is exactly why traditional ways of valuing a company often just fail. You've got analysts trying to predict earnings 5 years from now down to the third decimal point. It's a fool's errand for a company that's changing so quickly. With rule breakers, the goal isn't to be precisely wrong. It's to be approximately right about the big picture.
So you're probably thinking, okay, this all sounds great in theory, but does it actually work? It's a fair question. So let's look at the numbers. Let's see how this philosophy has actually performed out in the real world.
The data is, well, pretty staggering. At the time the source material was put together, the average return for a rule breaker stock pick was a whopping 97%. Now compare that to the S&P 500's return over those same time periods, which was 56%. That is a massive outperformance. And if you add up all of that outperformance across hundreds and hundreds of stock picks, you get to this incredible number, 12,500 total percentage points of alpha. In investing, alpha is the holy grail. It's the measure of how much you beat the market. And a number like this, well, it speaks for itself. It's an amazing track record built entirely on defined conventional wisdom. At the end of the day, this is more than just an investing strategy. It's a mindset. It's for the person who doesn't just see a lemonade stand. They see a global beverage empire. It's about looking at the world around you and constantly asking, how could this be done better? What's the next big thing that's going to change everything?
So I'll leave you with this question. Using this new framework we've talked about, just take a look around. Look at the tech you use, the services you rely on, the brands you really love. Which companies out there today are the top dogs, the visionaries, the ones being called overvalued while they quietly build the future? Which rule breaker is changing your world right now?
You know, we're all looking for that edge in investing, aren't we? That one framework that helps us spot the next big thing before everybody else does. Well, today, we're going to dive into a really fascinating approach designed to do just that. It's a set of 6 signs to help us identify these rule breaker companies that could become the massive winners of tomorrow.
So, the source for this explainer, the Motley Fool, kicks things off with a pretty provocative idea. They actually suggest that the 4 most common words in investing might also be the most dangerous. So, what are these words that could be holding us all back?
Buy low, sell high. I mean, that sounds like the golden rule of investing, doesn't it? It's the first thing you learn. But the framework we're digging into today argues that when you're hunting for truly revolutionary companies, that exact mindset can actually be a trap. So let's get into a completely different way of thinking. To find tomorrow's winners, we really can't rely on yesterday's rules. This is all about thinking differently. It's about adopting what they call a rule breaker mindset to spot true game-changing innovation. And that brings us right to the rule breaker philosophy itself. It's a very specific framework designed to spot these high-growth companies early and then hold on to them for the long haul. At its core, it's really all about recognizing the patterns of greatness. Okay, so here's our game plan. We're going to walk through all 6 signs of a rule breaker, one by one. We'll start with how they dominate their market, then why winners just keep on winning, the huge importance of the people and the brand, a pretty contrarian take on value, and we'll finish up with a simple but really powerful challenge for you. Now, before we jump into the 6 signs, I want to show you this really useful mental model. It's called the Gartner hype cycle. It basically shows the typical path of any emerging technology. You know, from that initial crazy hype, then through this period of disillusionment where everyone gets disappointed, and then eventually to real-world productivity. The key takeaway for us? Rule breakers are often found right here in phase 1. The challenge, and of course the opportunity, is having the guts to hold on through that entire wild ride.
All right, let's get right into the first two signs. These are really the cornerstones of any rule breaker company. It's all about how they absolutely dominate their market. So, sign number one is being the top dog and first mover. And honestly, this is probably the most important trait of them all. We are looking for the company that didn't just join a market, they literally created it. They're the pioneers, and they become the leaders in an important, brand new industry. And just look at these examples. It's not just about the huge tech giants like Baidu and Salesforce. Think about Starbucks or Whole Foods, right? They didn't invent coffee or groceries, of course, but they completely redefined the entire experience and did it on a massive scale. They became the top dog by creating and then dominating a whole new category. Okay, so once a company becomes the top dog, you can bet competitors are going to come knocking. And that brings us to sign number two, a sustainable advantage. This is their moat, their defense system, and I love how the side puts it. The real question is, how many alligators are in it? Let's look at the 4 ways a company builds that defense.
According to the source, that moat comes from 4 main places. First, just sheer business momentum, a company that's just unstoppable. Second, you've got your legal protections, like patents. Third, visionary leadership, a founder who just sees the future differently. And finally, and this one is surprising, just plain old inept competition. And oh my gosh, this slide is the perfect illustration of inept competitors. Netflix's dominance wasn't just built on their own genius, it was supercharged by Blockbuster's massive mistakes. I mean, when your rival turns down the chance to buy you for $50 million and then waits 6 years to even compete, well, they're not just letting you build a moat, they are literally handing you the crocodiles. So now we're moving on to sign number 3, and this is where the rule breaker mindset really starts to challenge conventional wisdom. This sign takes that old buy low mantra and flips it completely on its head. Conventional wisdom tells us to go hunt for bargains, right? To shop for stocks that are on the discount rack. The rule breaker approach is the total opposite. It says, go invest on Fifth Avenue. The idea is that a rising price isn't a warning sign. It's a sign that the rest of the market is finally recognizing a true winner. And this is the core idea behind looking for strong past price appreciation. Winners tend to keep winning. So why is that? Well, because a great company's success creates this incredibly powerful momentum. It attracts more customers, more talent, and more investors. It creates this virtuous cycle where the rising stock price is just a reflection of an ever-strengthening business. So, we've covered market dominance and that forward momentum. Now, let's turn to signs 4 and 5, which are all about the human element, the people and the brand that are so critical for long-term success. Sign number 4 is good management. And this goes way beyond just a great CEO. We're looking for visionary founders, people who are often obsessed with their mission. And here's a key tell. Look at who's backing them. When you see top-tier venture capital firms on the list, that is a massive vote of confidence from some of the smartest investors on the planet. Next up, we've got sign number 5, strong consumer appeal. And this definition on the slide is just perfect. A brand is a promise. When a company delivers on that promise consistently every single day, it becomes a mental shortcut for us as consumers. It saves us time and the effort of choosing. That loyalty is incredibly valuable, and it's what gives great brands their staying power. And now for our final sign, number 6. And this is maybe the most rule-breaking idea of them all. It's what really separates this approach from conventional Wall Street thinking.
You have seen this headline a million times, right? The financial media just loves to call fast-growing, innovative companies overvalued. They'll point to traditional things like the PE ratio and declare that the stock is just way too expensive.
But the rule breaker framework asks us to just flip our perspective entirely. What if that overvalued label isn't actually a red flag, but a green light? It often means that the traditional investors, the ones stuck on old metrics, are still sitting on the sidelines. It's a sign that the company's true disruptive potential hasn't been fully appreciated yet. And as that company keeps delivering, those skeptics eventually become buyers, pushing the stock even higher. So, there you have it. We've journeyed through all 6 signs of a rule breaker, a complete framework for spotting potentially game-changing companies. Now let's wrap all this up with a final, really powerful challenge.
You might have heard that famous advice from the legendary investor Peter Lynch. You should be able to explain why you own a stock in 2 minutes. Well, the Rule Breaker Challenge raises the bar. It says that for a truly great company, it shouldn't take 2 minutes. It should take just 1 sentence.
And really, that's the ultimate test of this whole framework. It forces you to find the absolute core of what makes a company great. So I'll leave you with that challenge. Think of a company you really admire. Can you distill its greatness, its magic, into a single powerful sentence? Give it a try.
Have you ever wondered what it really takes to find those game-changing investments? You know, the ones that don't just make money but actually change the world? Well, today we're diving into a philosophy that says the path to those incredible returns often starts with a little bit of ridicule and a whole lot of imagination. So the big question is rule breaker investing the right fit for you? Let's find out.
Here's how we're going to break it down. We'll kick things off with a surprising story from, of all people, Dr. Seuss. Then we'll pull 4 key insights from it. After that, we'll get real about the price you pay for this kind of strategy, understand the wild math that makes it all work, and finally, we'll talk about where you might find the next big thing.
So to really get our heads around this whole investment approach, we're not starting with some complicated stock chart. Nope. We're starting with a story. And it comes from a place you'd probably never expect, a children's book called McElligot's Pool. Turns out, it's the perfect story for what it truly means to be a rule breaker. And this right here, this is where it all starts. You've got a young boy fishing, and a farmer, who basically represents the voice of conventional wisdom, comes along and just laughs at him. He dismisses the whole idea out of hand. And that ridicule? That's the very first test for any idea that dares to break the rules.
So the setup is really simple. This kid's been fishing for hours, hasn't caught a thing. The farmer tells him he's just wasting his time. But instead of just packing it in and going home, the boy's imagination completely takes over. He starts dreaming up this incredible, unseen world of possibilities just beneath the surface of that tiny little pond.
Now what's so cool about this is how this simple kid's story gives us 4 incredibly powerful insights, let's call them lessons from the pond, that really form the absolute core of the entire rule breaker strategy. Okay, so here they are. First, being ridiculed can actually be a great sign. Second, you have to be honest with yourself that you might be wrong. Third, patience is not just a virtue, it's absolutely essential. And fourth, and maybe the most important, imagination is your secret weapon for seeing the future.
This first point is so important. When the so-called experts, the farmers of the world, when they laugh at an idea, it should set off bells in your head. It's often a flashing green light, because it might mean you're onto something so new, so disruptive, that they just can't wrap their minds around its potential yet. Those farmers are actually amazing contrarian indicators.
And hey, this is not just some cute theory from a book. Think about the real world. People laughed at Baidu, calling it an overvalued, untrustworthy Chinese search engine. They said about Tesla, "Oh, come on, electric cars will never sell." And they wrote off Facebook as a failed IPO. That initial skepticism, that was the price of admission for some absolutely mind-blowing growth. Now here's the flip side. Even with a brilliant idea, the boy in the story is humble. He actually admits, maybe the farmer's right. For us as investors, that means having some intellectual humility. You gotta acknowledge you could be dead wrong. Don't let your ego convince you to bet the farm on a single stock. Diversification is your best friend.
And Dr. Seuss himself just nails the third point with this quote. These big, world-changing ideas, they take time to play out. It's not like planting a seed and expecting a giant oak tree the next morning. Rule breaker investing is a long-term game. It rewards the people who are willing to be patient and wait for their wish to come true.
And finally, it all comes back to imagination. The boy could see a whole world of fantastic, unbelievable fish where the farmer just saw a dirty little puddle. If you want to invest in things like surgical robots or cutting-edge lasers or cures for cancer, you need that same kind of imagination. You have to believe in what could be long before it becomes obvious to everybody else.
All right, so that's all the exciting, optimistic stuff. But let's be real. Investing this way comes with a very real cost, and it's time for a serious reality check. Let's talk about the price of betting on these big ideas.
See, here's the catch. These kinds of stocks aren't valued based on what they're doing today. Their prices are based on a spectacular, amazing, world-changing tomorrow. That massive success is already baked into the price. So if that future doesn't quite show up,
Or maybe it's just kind of better. That stock price is going to get hammered.
And when I say hammered, I'm not kidding. With these stocks, good news gets amplified, but so does bad news. It is absolutely not out of the question for one of your stocks to drop 30% in a single day.
So you really have to ask yourself and be honest about it. Can you handle that? Do you have the stomach for that kind of wild ride? If just the thought of that kind of drop makes you feel sick, then this style of investing is probably not for you. And you know what? That is perfectly okay.
But here's the thing. If you can stomach that roller coaster, there's a powerful logic that makes it all worthwhile. It's all about a strategy of swinging for the fences, and the math behind it is what makes the whole thing work.
The whole mindset is a lot like how venture capitalists think. You make a bunch of smart investments in great opportunities, but you go in expecting that a lot of them are going to be strikeouts. And that's fine, because you know that the few that turn into home runs will more than pay for all the misses.
Okay, get ready for this, because it sounds totally backward at first. The actual accuracy rate, the percentage of these stock picks that actually end up beating the market, is often less than 50%. Yeah, you heard that right, less than half. It sounds like a failing grade, right? But here's why it actually works.
The secret is in what we call asymmetric returns. The math is on your side. Think about it. Your losses are capped. A stock can only go to zero, but your gains, they're unlimited. So let's say you have a portfolio of 10 stocks. If one is a total dud and loses 50%, your whole portfolio only drops by 5%. But if just one of them is a massive home run and goes up 500%, your entire portfolio goes up by 50%. See? That one monster winner just completely erases the loser and then some. So the huge takeaway here is this. You have to diversify, and you have to keep your eyes focused out the front windshield, not in the rearview mirror. Stop obsessing over your losers. In the long run, your winners will more than make up for them. That's the engine of this whole strategy.
All right, that brings us to the final and maybe most exciting question. Now that we have this philosophy, how do we actually go out and find the future? Where should we be looking for the next McElligot's pool? Now, it's super important to get this next part right. This is not about blind gambles or throwing darts at a wall. The real key is to find companies that are already winning, companies that have already successfully created a new market or a new niche. The bet isn't just that they'll succeed, it's that they will keep on succeeding.
So I'm going to leave you with this question to chew on. Just look around at the world today. Where do you see the rules being broken? Where are those creative disruptions happening that have the potential to change absolutely everything?
Could it be in solar power? How about robotics? Maybe the constant evolution of cloud computing? Or is it virtual reality? The future is, by definition, uncertain. But for a rule breaker, that's not a scary thing. That's the ultimate opportunity. The next McElligot's pool is out there. You just have to have the imagination to see it.
All right, welcome to The Explainer. Today, we're really going to get our hands dirty. We're climbing under the hood to break down a pretty cool framework for finding those promising small cap stocks, before they get huge.
Okay, so let's just dive right into it. What we're going to do is walk through this 8-point checklist. Think of it like a system, right? It's designed to help you screen for companies that have some serious growth potential. The whole idea is to help us spot those hidden gems out there in the market.
I mean, this really is the million-dollar question, isn't it? How in the world do you find the next big company before it's actually big? The next Apple, the next Google, while it's still tiny. Well, that's exactly where having a clear, repeatable system gives you this massive advantage. It just helps you cut through all the noise.
All right, so to see how this framework actually works in the real world, we're going to use let's call it an illustrative case study. It's totally fictional, but it's a perfect example. We're going to look at a company called Messenger. Yep, you heard that right. Messenger actually got its start by taking one of the most overlooked things you can imagine, that little paper scroll inside of a fortune cookie, and just totally reinventing it.
So their big idea was really a two-part innovation. First off, the paper itself, it was edible and flavored, kind of like a breath freshener. They called it Tasty Scroll. And second, the messages actually had value. So instead of those vague fortunes, you'd get like stock tips, sports picks, even business ideas. Pretty clever.
And you know what? The market absolutely loved it. The info cookie was a huge hit. I mean, it was winning industry awards. It even landed Messenger on the Forbes list of hottest small companies. Business was just booming.
But, it wasn't all smooth sailing. A pretty critical op-ed in the New York Times came out, and it really took issue with their plan to make those inspected by slips in your clothes edible. It raised some safety concerns. Well, that story caused a bit of a panic, and the stock, it just tumbled, dropped 33% in a single day. Okay, so now that we have that background, let's actually put Messenger to the test using this checklist. We're going to start with the first 3 points. And these are really just filters, right? They're all about making sure we're looking at the right size of company to begin with. All right, so these first few rules are pretty straightforward. They're basically just screens. We're looking for a company with sales under 500 million bucks, because that leaves a ton of room to grow. Then we want daily trading volume somewhere between $1 and $25 million. That ensures there's enough liquidity, you can get in and out, but it's not totally overrun by the big Wall Street institutions yet. And a share price over $7, that just helps filter out some of the more speculative, kind of unstable penny stocks. As you can see, Messenger passes all 3 with flying colors. No problem. Okay, so let's move on to the next set of tests. Now, this is where we really start to dig into the company's actual business performance, the quality of the operation.
So, rule number 4 is all about profitability, specifically the net profit margin. Now, what this tells you is super simple. For every single dollar in sales a company makes, how many cents do they actually get to keep as pure profit? A really high number here suggests the company has a strong competitive edge, something that lets them charge premium prices.
And finding the numbers for this is way simpler than you might think. You just have to pull up the company's income statement. And for this calculation, you can ignore almost everything else. We only care about 2 lines. The very top line, which is revenue, and the very bottom line, net income. The math itself is about as easy as it gets. Seriously. You just take that bottom line profit, the $7.4 million, and you divide it by the top line sales, the $50 million. And what that gives you is the percentage of sales that the company actually gets to keep after every single cost, every expense has been paid. And the result for Messenger? An incredible 14.8%. I mean, think about that. That's more than double our requirement of 7% and way, way above the average for a typical business. This is a really powerful sign of a high-quality operation. So yeah, that's an easy pass.
And it just keeps on rolling. It cruises through our next 2 tests. Its sales and earnings growth, over 80% year over year. That just crushes the 25% minimum we're looking for. And then look at this. A whopping 35% of the company is owned by insiders. We're talking the founder, the CEO. That is a huge vote of confidence. It tells you that management's interests are perfectly aligned with shareholders. Okay, so far, Messenger looks like an absolute slam dunk investment, right? It's checking almost every single box. But this next rule, rule number 7, well, it's arguably the most important one of all. And this is exactly where we find a critical problem just hiding right below the surface.
Okay, pay attention to this because it is absolutely vital to understand this distinction. Profit is not the same thing as cash. Not even close. See, profit is really just an accounting concept. It's numbers on a page. Cash, on the other hand, is the real, physical money that a business needs to pay its bills, to pay its employees, and to pay its suppliers. And this right here is such a common and frankly dangerous assumption that investors make. You see a profitable company and you think, great, they must be generating cash. But just because a company reports a profit on its income statement, it doesn't mean it's actually bringing in any cash. And Messenger is the absolute perfect example of this problem.
I mean, this just highlights the crazy contradiction, doesn't it? How on earth can a company with a nearly 15% profit margin actually be losing cash? Well, it turns out that for Messenger, the very act of growing the business so fast is consuming cash faster than they can bring it in.
And this lays out the core issue perfectly. See, to fuel that crazy fast international growth, Messenger offered its new customers super generous payment terms. So while it was booking huge sales on paper, its customers were taking over 120 days, 4 months, to actually pay up. But here's the kicker. Messenger still had to pay its own bills for things like sugar and rent within 30 days. You see the problem? This created a massive, dangerous cash crunch. Okay, so that cash flow failure, that is a major red flag. So with that in mind, let's look at the final rule on our checklist, and then we can tally up Messenger's total score. The last test is a simple one. It's called relative strength. Basically, all we want to see is that the stock's price is already in a general uptrend. We're looking for winning businesses that the market is also starting to recognize as winners. And since Messenger's stock has more than tripled in the past year, well, it easily passes this final test. So, here it is, the final scorecard. And on the surface, Messner looks phenomenal, right? It passed an incredible 7 out of the 8 tests. But that one single failure, that negative cash flow, that's not some minor issue. It is a critical flaw that suggests the whole business model might be unsustainable without taking on a bunch of debt or watering down shares. And really, this is the ultimate takeaway here. No single number, no checklist can ever tell you the whole story. A company can look almost perfect on paper and still have a fatal weakness hiding inside. And that's exactly why it's so essential for every single investor to be willing to climb under the hood and truly understand how a business actually works. Okay, let's talk about income statements. Now, I know exactly what you might be thinking. Pages and pages of numbers, weird accounting terms, it sounds kind of boring, right? Well, I'm here to tell you that's completely wrong. An income statement isn't just some dry document. It's a story. Seriously. It's the whole narrative of a company's performance, its big wins, and maybe, just maybe, its hidden secrets. All right, let's get into it. So, to really learn how to read this story, we're going to look at a case study. We'll use a fictional company I'll call Messenger Inc. And, at first glance, Messenger looks like the absolute perfect hero for any investor's fairy tale. I mean, just look at these numbers from their early years. Revenue just exploded, going from 8 million all the way to 50 million. Net income, that's the profit they have left after paying all the bills, went from a tiny 450 grand to over 7 million. And the earnings per share, which is basically the company's profit divided up by all its shares, it grew almost 20 times over. This is exactly what you'd call flawless, explosive growth. It's a dream. Yeah, this quote pretty much nails it, doesn't it? On paper, Messenger is the kind of company that investors spend their whole careers hoping to find. It's the one you see on all the hottest small companies lists. It just seems like a total can't-miss opportunity. So, you can imagine, with a history that good, everyone was just waiting on the edge of their seats for the next annual report. And when it finally dropped, well, this is where our perfect little story takes a very, very sharp turn. And here it is. And hey, at first glance, things look great. The good news is still rolling in. Revenue almost doubled, up 94%. Net income jumped a massive 70%. I mean, these are just fantastic numbers, right? They blew away all the expectations. So what do you think happened to the stock price? It must have gone to the moon, yeah? It got crushed. The stock, ticker MSS, dropped 22% in a single day. The market absolutely hated this report that, on the surface, looked brilliant. So what on earth happened? This right here is the big mystery we're going to solve today. What did the smart money see that so many other people just glossed over? The answer isn't buried in some secret memo. It is right there in the income statement, hiding in plain sight. You just have to know where to look. All right, to crack this case, we're going to have to become financial detectives. We're on the hunt for 4 very specific clues, 4 red flags that can turn a beautiful headline into a really worrying trend. So our first clue is all about shrinking profit margins. See, it's not just about how much money a company makes in total. What's really important is how efficiently it makes that money. Think of it this way. For every single dollar the company brings in from sales, how many cents does it actually get to keep as profit? That percentage, that's its profit margin. And here we see the problem. Back in 2015, Messenger kept a pretty healthy 14.8 cents of profit for every dollar in sales. But a year later, even though their total profits were way up, that margin shrank to just 13 cents. They were working way harder, but they were actually becoming less efficient. For investors who are trying to look into the future, a downward trend like this is a massive red flag. Okay, clue number 2. This one involves a classic trick that companies sometimes use to make their short-term profits look better. If a company feels like it's under pressure to hit its numbers for the quarter, one of the easiest things to do is just slash the budget for research and development. It makes today's profit look fantastic, but what you're really doing is mortgaging your company's future. And this slide shows exactly what Messenger did. Their R&D spending as a percentage of their revenue just fell off a cliff, from 12% all the way down to 4.6%. For a tech company, a company that needs to innovate to survive and grow, this is a huge blinking warning sign. It really suggests they starved their future just to make this year's numbers look a little better. On to our third clue. You know, sometimes a company's profits can look artificially high just because they paid a super low tax rate for the year. This can happen for a bunch of reasons, like if they're using credits from previous years when they lost money. The point is, it's not sustainable, so it's always something you've got to check. So in Messenger's case, we take a look and we see they paid a 33% tax rate in 2015 and 32% in 2016. You know what? That's totally normal. So this clue was a dead end in our investigation, but, and this is important, it was still a critical step. A good detective checks every single lead. All right, our fourth and final red flag is all about the size of the pie. I want you to think of a company's total profit as a big pizza, and the number of shares represents the number of slices. Now, if the company suddenly decides to issue a bunch more shares, what happens? Well, your slice of the pie just got smaller. This is what we call share dilution. And that is exactly what happened here. Messenger issued 2 million new shares. This is the aha moment. This is precisely why the net income grew by a huge 70%, but the earnings per share grew by only 42%. The whole pie got bigger, sure, but it was divided into way more slices, and that waters down the value for everyone who already owned a slice. So we found the clues, right? Shrinking margins, cuts to R&D, and share dilution. We've pretty much cracked the case of why the market freaked out. So now let's talk about how the market takes all this information and puts an actual price tag on a company. Probably the most common tool for this is the price-to-earnings ratio, or PE ratio. In really simple terms, it's just the stock's price divided by its earnings per share. It tells you how much the market is willing to pay for $1 of that company's profit. But here's the thing. A PE ratio all by itself is completely meaningless. It needs context. Let's look at this example. Both of these companies earn 50 cents per share, but Doors Inc. trades at a PE of 60, while Yucky Yogurt trades at a PE of 10. Why the huge difference? Well, it's because the market believes Doors has this incredible future ahead of it, while Yucky Yogurt's future looks, well, yucky. The market always pays a premium for a better story and for higher expected growth. So, to add that crucial context we were talking about, investors use a really handy tool called the PEG ratio. It's a simple formula that connects the PE ratio, the price tag, to the company's expected earnings growth rate. It really helps you see if you're paying a fair price for all that future growth. And the calculation is really simple. You just take the PE ratio, so in our example, 60, and you divide it by the projected earnings growth rate. If the growth rate is, say, 50%, you just use the number 50. So 60 divided by 50 gives you a PEG ratio of 1.2. A value somewhere around 1 is often considered a sign that a stock is fairly valued, but of course it always depends on the industry you're looking at. Okay, let's pull all of this together. We've gone all the way from what looked like a perfect growth story to uncovering some hidden flaws, and now we've learned a bit about how the market actually prices those details. So, what's the single most important lesson to take away from all this? The key is to always look beyond the headline number. You have to check the trends in profitability. You've got to make sure the company is investing in its future, not stealing from it. You have to watch out for that sneaky dilution that shrinks your ownership stake. And then you use tools like the PE and PEG ratios to really understand the story that the stock price is telling you. In the end, a company's financial report is just like a book. The headline numbers, that's the flashy cover, they're designed to grab your attention. But the real story, the one that tells you whether it's going to have a happy ending or not, is always found in the chapters that follow. So, the final question I'll leave you with is this. An income statement tells a story. Are you reading beyond the first page? You know, we're always told to follow the headlines, especially when it comes to investing. But what if the real story, the actual truth about a company's health, isn't in the big splashy headlines? What if it's hidden in plain sight? Well, today we're going to decode two absolutely critical financial documents that tell that story, the balance sheet and the statement of cash flows. Okay, so let's start with a question. Picture this. You see a headline pop up on your phone. Some company just posted record-breaking profits. your first thought is probably, wow, this is a sure thing, a guaranteed safe investment, right? But what if I told you that profit doesn't always mean cash in the bank, and that one little difference is what separates a truly savvy investor from the rest of the pack?
So our first tool in this financial investigation is the balance sheet. The best way to think about it? It's like a high-resolution photograph. It's not a movie showing you what happened all year long. It is a single, frozen snapshot of a company's financial health on one specific day.
Yeah, and that snapshot idea is super important. An income statement, that tells a story over a whole year. But the balance sheet just freezes time on the very last day of a reporting period and says, bam, at this exact moment, here is everything we own and here is everything we owe. And the whole thing, the entire balance sheet, it all boils down to this one simple, almost elegant equation. On one side, you have assets. That's all the stuff the company owns. On the other side, you have liabilities. That's what it owes to other people, plus shareholders' equity, which is the net worth that actually belongs to the owners. And the key, the whole point of the balance sheet, is that those two sides have to be equal. They must always, always balance out.
All right, to make this less theoretical, let's bring in our case study, a company we'll call Messenger, Inc. So in 2016, their total assets were $90,300. And if you look over on the other side, total liabilities plus equity, boom, exact same number. See? Perfect balance. So let's start digging in and see what these numbers are actually telling us. First up, assets.
Okay, so we're starting on the asset side of the balance sheet. This part lists everything a company owns that has value. But here's the thing you have to remember. Not all assets are what they seem. Some of them can actually hide some pretty serious problems.
So when you're looking at a company's assets, there are really three big things you want to keep your eye on. First up is cash, actual money. That's always good. But then you have these other two that, well, you need to be a little suspicious of: accounts receivable and inventory.
I absolutely love this quote because it just completely reframes how you should look at these things. On paper, they're called assets, but in reality, they represent a problem. Accounts receivable is just a fancy way of saying IOUs from your customers. And inventory, that's just stuff sitting on a shelf that you haven't sold yet. So the big takeaway here is you've got to watch these two numbers like a hawk. Okay, so let's flip this thing over and look at the other side of the equation. This is where we get to see what the company owes, that's its liabilities, and what's actually left for the owners, the equity. Basically, this side tells us who really has a claim on all that stuff, all those assets we just talked about. Now, when you're scanning the liabilities, the number one thing to watch out for is long-term debt. Look, debt can definitely help a company grow, but man, it is a dangerous game. A company with low debt, they're in the driver's seat. They own their destiny. They don't have to worry about bankers or rising interest rates. That kind of financial freedom, it's a huge, huge advantage. So imagine the company sold all its assets and paid off every single one of its debts. What's left over, that pile of cash, that's shareholders' equity. It really is the bottom line. It's the company's true net worth, the piece that actually belongs to the shareholders. The owners. Okay, so looking at these numbers in isolation is fine. But where the real magic happens is when you start comparing them to each other. That's when you can see the trends. So we're going to use a couple of simple ratios. And don't worry, this isn't going to be a math class. Think of these ratios as our financial detective tools. They help us find the clues that are hiding right under our noses. First tool in our kit, the current ratio. It's super simple, but it tells you so much about a company's health. You just take the current assets and divide them by the current liabilities. Basically, it tells you, if things get tough, can this company pay its bills for the next year? It's like a financial agility test. All right, let's apply this to Messenger. The numbers themselves look okay, but the trend is where the story is. So in 2016, the current ratio is 3.2. That's pretty good, but it's down from 3.4 the year before. And the quick ratio, which is even tougher because it ignores inventory, shows the same thing. It dropped from 2.7 down to 2.4. Now, one little dip isn't the end of the world, but a trend that's pointing down? That's our first little yellow flag. Okay, next up is a really big one, maybe one of the most important measures out there, return on equity, or ROE. This ratio answers a super simple but critical question. For every dollar shareholders have invested, how much profit is the management team squeezing out of it? You generally want to see an ROE of at least 12%, and anything around 20% is fantastic. So, what about Messenger's ROE? In 2015, it was 20%. That's awesome. But in 2016,
even though their net income went up, the ROE actually dropped a little bit to 19.1%. Now, let's be clear, that's still a really good number, but it's another little piece of evidence pointing in the wrong direction. The list of things to worry about is getting a little longer. Okay, so let's recap. Profits are up, which sounds great, but we've seen a couple of ratios start to trend downward, which is not so great. So to get to the bottom of this, to find out what is really going on, we need to bring in our final piece of evidence, the statement of cash flows. This, my friends, is the document that doesn't lie. This is where we find the truth. You've probably heard the saying, cash is king. And it's a cliche for a reason. It's absolutely true. I mean, think about it. A company can't pay its employees with profit. It can't pay its rent with profit. It needs cold, hard cash. At the end of the day, a business's survival depends on its ability to generate cash, not just report profit on a spreadsheet.
So what's the big difference here? Well, the income statement, that's the one that reports profit, it records a sale the second it happens, even if the customer is paying on credit and the cash won't show up for months. But the cash flow statement, it's way simpler. It's like your own bank account. A transaction only gets recorded when cash actually enters or leaves the building. That's it. One tells the story of profit. The other tells the story of cash.
And here it is, the smoking gun. Just look at that bottom line for Messenger. Net cash provided by operating activities. In 2015, they generated a positive $5.2 million in cash. Great. But in 2016, oh boy, it was negative $4.9 million. So wait a minute. They reported higher profits, but they were actually losing cash? How is that even possible? This chart just says it all, doesn't it? I mean, look at that massive drop. It's like falling off a cliff. In just a single year, Messenger went from making over $5 million in cash to losing almost $5 million. This right here is the giant flashing red light that record profits headline completely missed. So this leads us to the million-dollar question, or in this case, the $12 million question. They told us they made a profit of over $12 million, so where in the world did the cash go? And here's the answer. That $20 million number, that's the increase in money owed to Messenger by its customers. So in simple terms, they made a ton of sales, but they didn't get paid for them. The cash isn't in Messenger's bank account. It's still sitting in their customers' bank accounts, and that one single problem was big enough to sink their entire cash flow. So what's the big takeaway from our little investigation into Messenger? It's this. Reported profit can be, and often is, very misleading. To really know what's going on with a business, you have to follow the cash. And I want to leave you with a pro tip, something you can use to get a real edge. In any company's annual report, look for a section called Liquidity and Capital Resources. It sounds boring, I know, but this is the part where management has to stop with the accounting jargon and just tell you, in plain English, what their plan is for their cash and finances. It's an incredible peek behind the curtain. So from now on, when you see that headline about record profits, you're not going to take it at face value. You're going to know to ask the smart question. That's nice, but show me the cash. You've got the tools now. You can look right past the hype and find out what's really happening. So the only question left is, what company's story are you going to dig into next?
Welcome to The Explainer. Today, we're going to talk about something that goes way beyond just buying and holding stocks. We're diving into a really powerful and, let's be honest, pretty risky investment tool, using margin. You know, it's that edge a lot of investors are looking for, but there's a good reason why it's a path that not everyone takes.
All right, so let's really get into it. Is this thing a secret tool to just blow up your stock market gains? Or is it more like a trap just waiting for someone who's a little unwary? Well, the truth is, it's kind of both. So we're going to unpack exactly how it works, what happens when things go right, and yeah, what happens when they go really, really wrong.
So here's what we've got on tap. First, we'll cover what margin even is. Think of it as an investor's credit line. Then we'll look at how it can magnify your gains, but also why it's the broker's best friend. After that, we'll flip the coin and see how it magnifies losses, talk about the dreaded margin call, and wrap it all up with some final words of wisdom.
Okay, first up, the investor's credit line. So what exactly is margin? What are we even talking about when we say investing on margin? Well, when you boil it all down, it's pretty simple. It's about using borrowed money to invest. All right, so think about when you open a brokerage account. You've got a choice to make.
On one hand, you've got your standard cash account. Super simple, right? You just buy stocks with the money you actually have in there. But then there's the margin account, and that's a whole different ballgame. This is where you can actually borrow money from your broker to invest more than you have. So a margin account is basically a brokerage account that lets you borrow money from your broker to buy securities. And the key word here, the thing that makes it all work, is collateral. It's basically like a secured loan. The stocks and whatever else you have in your portfolio, that's what you're putting up as a guarantee for the loan. Yeah, this quote from TD Ameritrade nails it. Having a margin account is like having a pre-approved credit line with your broker. See? It's designed to be super easy to tap into. But, and this is a huge but, it is absolutely not free money. You're paying interest on everything you borrow, just like with a credit card.
Now, there are some key rules of the road here, mostly set by the Federal Reserve Board. First off, you can generally borrow up to 50% of the purchase price of a stock. Of course, you're paying interest on that loan. And something that's really important to get, your buying power isn't set in stone. It actually changes every single day based on how your portfolio is doing. Oh, and there are restrictions. You can't just go and use margin on any old thing, like penny stocks or brand new IPOs.
All right, section 2, magnifying your gains. This is the good scenario. After hearing all that, you're probably wondering, why would anyone take on this risk? Well, to get why it's so appealing, we have to look at what happens when things go right. Let's check out the best case scenario.
Okay, let's look at the power of leverage with a winning bet. Check out these numbers. Let's say you've got $10,000 of your own money. You decide to go on margin and borrow another 10 grand from your broker. Now you've got $20,000 total, and you buy 1,000 shares of a stock that's trading at $20 a share. Fast forward 1 year, and you picked a winner. The stock skyrockets to $45 a share. Your portfolio is now worth $45,000. So you pay back the broker their $10,000, plus let's say $800 in interest. What are you left with? A profit of $24,200. Pretty incredible, right? And here's where it gets really crazy. Look at the return on your initial $10,000 investment. Without margin, you would have made a 125% gain, which is fantastic. No one's complaining about that. But with margin, your gain was 242%. You literally more than doubled your return by using leverage. You see the appeal now? It's like putting your profits on steroids. I mean, that sounds way too easy, right? It almost feels like free money. So that brings up the big question. Why doesn't everyone do this? If you can supercharge your gains like that, why isn't this standard practice for every single investor? Well, the answer to that question leads us right into our next section, the broker's best friend. To figure this out, you have to ask yourself, who really wins here? And here's a hint, it's probably not you. You gotta remember, your broker has a vested interest, and I mean that literally, in you using margin. Why? Because the interest they charge you on that loan is a guaranteed, risk-free revenue stream for them. Your gains are speculative, but their profit from your loan is a sure thing. So what's good for the broker's bottom line isn't always what's good for your portfolio. And that brings us to the flip side of the coin. Section 4, magnifying your losses. Because this is the bad scenario. We've seen how good it can be, but what happens when that bet goes wrong? So let's look at how leverage cuts both ways. We're going to use the exact same starting point. You put in $10,000, you borrow $10,000 for a total investment of $20,000. But this time, the stock goes down. It drops 25% from $20 a share to $15. Your portfolio is now only worth $15,000. But guess what? You still owe the broker their full $10,000, plus the $800 in interest. After you pay them back, you're left with just $4,200. You've lost more than half your money. Just look at the impact of that 25% stock drop. If you hadn't used margin, you'd be down 25%. It hurts, but you'd still have $7,500. But because you used margin, that 25% drop in the stock turned into a 58% loss for you. This is the danger. It magnifies your losses just as much as it magnifies your gains. It's a brutal reality check. Believe it or not, it can actually get even worse than that. So let's talk about the ugly scenario. This is the one that every investor dreads, the margin call. Yeah, so what could be worse than those margin magnified losses we just saw? I mean, losing 58% is pretty bad, right? Well, what if I told you that you could be forced to sell and lock in those losses even if you don't want to? And that's what a margin call is.
It's a demand from your broker. They're telling you that the value of your collateral, your stocks, has dropped so much that you need to deposit more money or more securities into your account to bring it back up to the minimum level. It's not a suggestion, it's a demand.
So here's how a margin call unfolds, and it is absolutely terrifying. First, your stock's value drops, and your account equity falls below the broker's minimum. Then you get the call. You have to add more cash to your account, like right now. And here's the kicker. What if you can't pay? Well, the brokerage has the right to just start selling your stocks to cover the loan. They don't ask you, they just do it. They force you to sell low, locking in your losses at the worst possible time. All right, let's get to our final section, the fool's final word. We've seen the good, the bad, and the really, really ugly. So what's the big takeaway here? How should we think about this double-edged sword? Well, the advice is pretty clear. At the very maximum, if you are ever going to use margin, you should limit your borrowing to no more than 20% of your portfolio's value. Seriously, going all in and borrowing the full 50% is just asking for trouble. A tiny bit of leverage can be helpful in some situations, but too much is just a recipe for disaster. You know, there's that great Ben Franklin quote, "Experience is a dear teacher, but fools will learn at no other." It's so true here. You don't have to experience a margin call yourself to learn the lesson. In fact, a lot of the world's best investors just don't use it. They stay away from it entirely. It's better to learn from somebody else's mistake, right? So, after all that, why might you still want a margin account, even if you swear you'll never ever borrow money? It's a great question, right? And believe it or not, there might be a reason. But that's a story for another time. All right, today we're going to tackle one of the most controversial and, let's be honest, most misunderstood strategies in all of finance, shorting stocks. It gets a bad rap, right? People think it's cynical that you're betting against success. But is there more to it than that? Is it actually a super sophisticated tool that every serious investor should at least understand? Let's dive in and find out what it really means to go short. So, what is shorting really at its heart? Well, it's all about being a contrarian. Think about it like this. You're in a room and everyone is cheering for the same thing. The energy is huge. Everyone's on the same side. But you're the one person who sees something everyone else is missing, a reason to be cautious. It's a bet against that popular opinion, against the momentum of the crowd. Here's a great way to think about it. Picture a craps table in Vegas. Almost everyone is betting on the pass line. They're all in it together, rooting for the shooter. But there's this other bet, the don't pass. That's the short seller. You're literally the one person betting against the entire table. You win when they all lose. It might not win you any friends at the table, but it's a perfectly valid bet. This is the world of the wrong bettor, and it's pretty much exactly how short sellers are seen in the market. Okay, so here's what we've got on tap. First, we're going to dig deeper into what it really means to bet against the crowd. Then we'll get into the nuts and bolts of how shorting actually works. After that, we'll weigh the pretty serious risks and rewards. Then comes the fun part, how to spot a good target. We'll also cover some common pitfalls to watch out for, and we'll wrap it all up with a contrarian conclusion. All right, first up, this whole idea of being the wrong bettor. Like we said, just like at that craps table, short sellers are definitely seen as going against the grain. And sometimes, yeah, they're not the most popular people in the room. You know, there are a couple of big reasons why most investors just won't touch shorting. First, there's this feeling that it's, I don't know, almost un-American to profit when a company stumbles. And second, there's a really practical reason. Look at any long-term chart. The stock market tends to go up. So if you're constantly betting on stocks to fall, you are, by definition, fighting the market's main trend. Okay, so how on earth is it even possible to make money when a stock goes down? Let's break down the mechanics, because it's a little bit of a mind bender. You're basically flipping the normal order of things on its head. You sell first and you buy later. So let's get a clear definition down. Short selling is when you borrow shares of a stock you think is overvalued. You immediately sell those borrowed shares at the current high price. Then, and this is the key, you wait. You hope the price drops. Once it does, you buy the same number of shares back at the new, lower price, you return them to the person you borrowed them from, and you pocket the difference. And you know what's wild? Your broker does almost all the heavy lifting for you. Step 1, you just tell them what you want to do. They go out and borrow the shares. Step 2, they sell them for you. Step 3 is all you. You wait. Then when you're ready, you hit the button for step 4 to buy to cover, and boom, step 5 happens automatically. The shares get returned.
Your job is really just to make the two big decisions, when to sell and when to buy back.
Okay, let's run through a quick example with some actual numbers, because that's where it really clicks. Let's say you short 100 shares of a fake company, Overrated Technologies, at $56.50 a share. Instantly, $5,650 goes into your account. Now, if you're right and the stock tanks to $46.50, you buy back those 100 shares. It only costs you $4,650. You made $1,000 profit. Easy, right? But, and this is a big but, what if you're wrong? What if the stock goes up to $76.50? You still have to buy those shares back, and now it costs you $7,650. You just lost $2,000.
And that loss scenario, well, that leads us straight into the biggest, scariest part of short selling. See, when you buy a stock, the most you can possibly lose is the money you put in. It can only go to zero. But when you short a stock, the risk is a whole different beast.
Yup, this is the one, the phrase that makes most investors run for the hills. Unlimited upside risk. What does that even mean? Well, in theory, there's no ceiling on how high a stock's price can go. You short a stock at $50, it could go to $100, $500, $1,000. And since you have to buy it back at some point, your potential loss is, theoretically, infinite. That's terrifying.
But hold on, here's the secret. No sane investor actually lets that happen. You manage this risk with a simple tool called a quitting price. It's your escape hatch. Before you even place the trade, you decide the exact price at which you'll admit you were wrong and get out. For example, you might say, if the stock goes up 20%, I'm done. I'm closing the position. Just like that, you've turned that scary, unlimited risk into a calculated, manageable loss.
So you might be thinking, okay, if it's so risky, why even bother? Well, the smart investors use it in two really powerful ways. The first, obviously, is to make money from a stock they've researched and believe is way overvalued. But the second is as a defensive move, a hedge. Imagine the whole market is crashing. All your regular stocks are losing money, but your short positions, they're making money, which helps soften the blow to your entire portfolio.
All right, you get the mechanics, you get the risks. So how do you actually find a stock that's ripe for shorting? This isn't about throwing darts at a wall. It's about being a financial detective. We're going to walk through 3 crucial tests to help you find a company that might be in trouble.
First up, we're playing detective with the company's financials. It's called the debt test. You're searching for a really dangerous combination, a mountain of debt and very little cash flow coming in to pay for it. And I love this analogy from our source material. If cash is the lifeblood of a company, then too much debt is like hemophilia. One tiny cut, one bad quarter, and the company can't stop the bleeding. You're looking for businesses that are using debt, not actual profits, to grow. That's just not sustainable.
Next, test number 2. This one is all about figuring out if a company's story is an open or closed book. You want to avoid open situations at all costs. Think about a company like Amazon 20 years ago. Its potential was basically unlimited. It could surprise everyone over and over again. Trying to sort a stock like that is a recipe for disaster. Instead, you look for closed situations. These are solid, maybe even boring companies in mature industries. They're past their hypergrowth phase. Think of Bed Bath & Beyond in the 90s. Good store, but was it going to invent the next iPhone? Probably not. Its future was way more predictable, which makes it a much safer short.
Okay, now for our third test. And I gotta tell you, this one is gonna mess with your head a little bit. It's completely counterintuitive. It's called short interest. That's just the total number of shares that are already being shorted by other investors. Now, you'd think a high number would be great news, right? Hey, look, everyone agrees with me. Wrong. It's actually a bad sign. Why? Because every single one of those shorted shares has to be bought back eventually. That's a huge amount of guaranteed future buyers, which can actually push the stock price up.
And we can actually measure this buying pressure with a simple formula called the short interest ratio, or days to cover. It's super easy. You just take the total number of shares that are shorted and divide that by the stock's average daily trading volume. So in this example, 4 million shares short divided by 200,000 traded per day equals 20. That number 20 means it would take 20 full trading days for all the short sellers to buy back their shares. That is a very, very crowded trade. So what's the takeaway here? It leads to a really simple, powerful rule of thumb. Only short stocks that have a days to cover ratio of 10 or less. Sticking to this helps you avoid a nightmare scenario called a short squeeze. That's when a little bit of good news hits the stock, it pops up, and all those short sellers panic and rush to buy back their shares at the same time. That rush of buying sends the stock to the moon, and if you're short, you get absolutely crushed.
Okay, we've gone through the big picture strategy, but before you jump in, we need to talk about some of the annoying little things that can pop up in the real world of short selling. They're not deal breakers, but you absolutely need to know about them. All right, let's just run through them real quick. 1. Sometimes you find the perfect stock to short, but your broker can't find any shares to borrow. 2. There's a thing called the uptick rule that can sometimes stop you from shorting a stock right when it's in free fall. 3. Very rarely, your broker might call you up and say, hey, the person we borrowed from wants their shares back, you have to close your position now. 4. That cash you get when you first sell the shares, you don't get to earn interest on it. And 5, and this is a big one, if the stock pays a dividend while you're shorting it, guess who has to pay that dividend? You do. And that brings us to our conclusion. Look, shorting stocks might make you feel like the Darth Vader of investing, rooting for the dark side, but looking past that reputation is a huge step in your journey as an investor. But here's the real bottom line. Even if you never ever short a single stock, understanding how it works, why it works, and how to spot a company that's a prime short target, that knowledge alone gives you a massive edge. It's what separates a sophisticated investor from a novice. It's a powerful tool, and now it's in your arsenal. Because in the end, this strategy is less about the math and more about your own conviction. It's about doing your homework so thoroughly that you have the confidence to stand apart from everyone else. So I'll leave you with this to think about. Now that you understand the game, when would you have the courage to place that bet against the crowd?
All right, let's talk about something that a lot of investors find, well, pretty intimidating. Stock options. You hear the term and maybe you picture frantic traders yelling on a stock floor. But what if I told you they're not nearly as complicated as they seem? Today, we are going to demystify stock options and show you how they can be a genuinely powerful and surprisingly safe part of your investment toolkit.
And let's be real, that quote just nails it, doesn't it? For so many people, options feel like this complex, chaotic world that has nothing to do with regular long-term investing. Our goal today is to take that chaos, break it all down, and turn it into a clear, understandable, and really powerful tool that you can use for your own portfolio.
So here's how we're going to do it. First, we'll shift our thinking about what options even are. Then we'll get into the basic language you need to know. After that, we'll learn the 4 fundamental moves, and finally, we'll put it all together with some real-world strategies. Sound good? Let's go. So let's just blow up a big myth right from the start. What if options aren't just for high-stakes, risky gambling? What if you could actually use them to reduce your risk, or to generate a steady income stream, or even to buy the stocks you already love but at a discount? Well, you can. This is the big mental shift you got to make. Stop thinking of options as one single scary thing. Instead, picture a toolkit, with a hammer, a saw, a drill. Each tool has a very specific job. That's what options are. They're financial tools that give you the flexibility to build your portfolio and even profit, no matter which way the market is heading. Okay, time to roll up our sleeves and get into the nitty-gritty. We're going to learn the essential vocabulary. I promise, once you get these few core terms down, everything else we talk about today is going to click right into place. This is the foundation for everything.
And listen, this is probably the most important part of the whole definition. The phrase, right, but not the obligation. The person who buys the option gets a powerful choice. They have the right to do something, but they're not forced to. That flexibility is the magic ingredient that makes options so incredibly versatile.
Think of the strike price as your locked-in price. It's the price that's written into the contract. So if you have an option to buy a stock at a $50 strike price, it doesn't matter one bit if that stock skyrockets to $60 or $70 on the open market. Your contract gives you the right to buy it for $50, period.
Every single option has a shelf life. It's just like a coupon. It doesn't last forever. This is the final date when the contract is valid. And you have a lot of flexibility here. Some options expire in just a week, while others can last for 2 years or even more. This lets you tailor your strategy for short-term or long-term goals.
So how does an option get its price, what's called the premium? Well, it's really made of 2 different parts. First, there's intrinsic value. That's its real, in-the-money value right now. But then there's also something called time value.
Think of this as the what-if value. It's the extra price people are willing to pay for all the potential things that could happen between now and the expiration date.
Okay, now we get to the fun part, the actual moves you can make. Every single option strategy out there, no matter how ridiculously complex it sounds, is just a combination of these 4 simple moves. Once you nail this, you've unlocked the whole game.
This slide just lays it out perfectly. There are 2 basic flavors of options. You have calls for when you're bullish and you think a stock is going up, and you have puts for when you're bearish and you think a stock is going down. The easiest way to remember it, you call up the phone and you put down the phone. Simple as that.
Now, this is where people sometimes get a little tripped up, but it's actually pretty simple when you think about it. For every single option contract, there's a buyer and a seller. The buyer pays money, the premium, to get that flexible right we talked about. Their risk is limited to whatever they paid. The seller, on the other hand, receives that money right up front, but in exchange, they take on an obligation. They're making a promise, and that's where their risk comes in.
All right, theory time is over. Let's see how this stuff actually works in the real world. We're going to walk through 3 really practical strategies, and we'll use a made-up company we're calling Peach Technologies, ticker symbol PCHI.
This first strategy, selling puts, is an absolute favorite around here. And why is that? Because you literally get paid cash up front for simply agreeing to buy a stock you already like, but at a cheaper price than it is today. I mean, how great is that? So here's how it plays out, step by step. Peach Tech is trading at $11 a share. You like the company, but you'd love to get it for $10. So you sell a put option with that $10 strike price. The moment you do that, someone pays you a premium, let's say $50. That goes straight into your account. It's basically like you're selling an insurance policy, and that $50 is your payment.
So no matter what happens, you end up in a pretty good spot. Look at the 2 outcomes here. If the stock price stays above $10, awesome. The option just expires, and you keep the $50 as pure profit. But what if the stock drops below $10? Well, you have to buy the shares at $10. But remember, you already got paid 50 cents a share, so your real cost is only $9.50. You got the stock you wanted at a fantastic discount. It's a true win-win.
Okay, let's flip the script. What if you're thinking, man, this stock is about to take off, but you don't want to tie up thousands of dollars buying the shares? This is the perfect job for our next tool, buying call options.
And this is where your jaw might drop a little. This is the power of leverage. Let's say Peach Tech stock goes from $11 to $14. If you own the stock, that's a nice 27% gain. Not bad at all. But if you had bought a call option instead, that exact same move in the stock could have supercharged your return to a massive 100% gain.
Okay, this table breaks it down beautifully. Let's look at the numbers side by side. To buy 100 shares of the stock, you'd have to put up $1,100. To control those same 100 shares with a call option, it might only cost you $200. Now check out the upside. The stock goes to $14. Your stock investment makes you $300. But your little $200 option investment doubles to make you $200 profit. And this is huge, look at the downside. If the stock totally crashes, the most you can ever lose with the option is the $200 you paid for it.
All right, one more core strategy for our toolkit. So far, we've talked about making money when a stock goes up or sideways. But what if you think a stock is headed down? You can use options to protect your portfolio or even profit from a decline. That's where buying puts comes in. So let's say you've done your homework and you think a competitor is about to eat Peach Tech's lunch. You could buy a put option that gives you the right to sell PCHY at $10. Then, if you're right and the stock plummets down to $6, your right to sell at that much higher price of $10 becomes extremely valuable. In this example, your option could be worth $4, turning your original $1 investment into an incredible 300% profit.
So what's the big takeaway here? How do you actually use this stuff without becoming a day trader glued to a screen? The key is to stop thinking of options as a separate thing. They are a tool that works with your long-term stock portfolio. You can use that selling put strategy to get paid while you patiently wait to buy a great company at a great price. Or you can buy a put as a short-term insurance policy on a stock you love but are worried about. It's all about making your existing portfolio work smarter and harder for you.
All right, let's do a super quick recap. Calls like it when stocks go up, puts like it when they go down. Remember, the buyer is paying for a right, a choice. The seller is getting paid to take on an obligation. And most importantly, these tools work alongside your stocks. Use them to generate income, get better prices on shares you want, or add a little bit of leverage to a great idea.
So we started this whole journey looking at that quote about intergalactic chaos. But hopefully we've taken that chaos and turned it into clarity. We've shown you the hammer, the saw, and the drill. We've filled up your investment toolkit with some powerful new instruments. The only question left is, what are you going to build?
So, have you ever looked at your savings account and just thought, is investing really worth it? I mean, for a lot of us, the stock market feels, complicated, a little risky, and maybe just not that rewarding for all the stress. It's a totally normal feeling. But today, we're going to pull back the curtain and show you why that first impression might be missing the single most powerful part of the whole equation.
All right, here's our roadmap. First, we're tackling what I call the $2 a day problem. That feeling that investing is kinda pointless. Then we'll get into the secret ingredient that changes everything, compounding. After that, we'll look at the two main paths you can take, index funds or individual stocks. And I'll even share a simple playbook for doing your own research. And finally, we'll talk about the real prize at the end of all this, playing the long game for something priceless.
Okay, let's dive right into that skepticism, because it's a real thing. It is so easy to look at the starting numbers and just feel completely underwhelmed. And you know what? At first glance, you're not wrong to feel that way.
This is the big question, right? You work hard for your money. The idea of putting it on the line for what feels like just a few cents here and there, it can seem like a really bad deal. Let's run the math real quick and see why.
Okay, imagine you've saved up $10,000. That's a solid chunk of change and you decide, I'm going to put this money to work. So you invest it.
Now, in an average year, the stock market might return about 10%. So after you pay your taxes on that gain, you're left with a profit of about $800.
And if you break that profit down by the day, it works out to just $2.19. Yeah, less than what you'd pay for a latte. You're probably thinking, I went through all that trouble for this?
Right? It's not inspiring at all. It feels like you spent all this energy pushing a giant rock up a hill just to find a nickel at the top. And look, if this was the entire story, I'd probably say, yeah, don't even bother. But it's not.
This whole calculation, this whole one-year snapshot, has a massive, glaring blind spot. There is one crucial piece missing that completely flips the script and turns this from hardly inspiring into something, well, life-changing. Any idea what it is?
The answer, the secret ingredient that makes investing so powerful, is compounded growth. This is the one concept that turns that sad little $2.19 a day into a real, actual wealth-building machine over time.
Okay, so this is where the magic really kicks in. Compounding means your money starts making its own money. See that $800 profit from year one? You don't take it out and spend it, you leave it in there. So in year two, you're not just earning a return on your original 10 grand, you're also earning a return on that profit. It's like a snowball rolling downhill. It just keeps getting bigger and faster.
Let's make this totally concrete. In that first year, your after-tax profit is about $67 a month. Okay, but you fast forward to year 10 without adding a single extra penny, and that same investment is now kicking off almost $148 a month. The percentage return is still the same, but the amount of actual cash it generates has more than doubled. That is compounding at work.
Now, let's zoom out and look at the big picture after a decade. Without you lifting a finger after that first investment, your initial $10,000 has grown to over $20,000. It has literally more than doubled, and that's even after taxes. And that brings us to the single most important lesson here. Investing is not about getting rich quick. It's about letting the simple, unstoppable force of time and compounding do all the heavy lifting for you.
So we've got the why down. Now let's get into the how. When it comes to harnessing this power, there are really two main roads you can go down, and they're built for very different kinds of people.
On one side, you've got passive investing. This is basically the set it and forget it strategy, where you just buy a big basket of stocks, like an index fund, and let the overall market do its thing. On the other side, you've got active investing. This is where you roll up your sleeves, do some homework, and try to pick individual winning companies to beat the market average.
Now, the index fund approach is probably the simplest and for many people the most effective way to go. You can buy something like an S&P 500 fund, which is just one single investment that holds a tiny piece of 500 of the biggest companies in the US. Think Google, Johnson & Johnson, Costco, you name it. Your money grows as they grow. You're basically letting all their brilliant employees work to build your wealth for you. And the best part? It frees up your time to actually live your life.
The index fund strategy is fantastic. It really is. But maybe you're a little intrigued by the idea of finding the next big thing. What if you want to actively search for those extra few percentage points of return that could really supercharge your growth?
Well, that's where the active approach comes in. And here's the good news. This isn't some dark art that's only for Wall Street wizards anymore. We have some incredible tools to do our own research, and they're right at our fingertips.
And what's really amazing is that you already use these powerful research tools every day. I mean, think about it. You're wondering if a certain restaurant company is a good investment? Hop on Yelp and see what their actual customers are saying. Curious if a company has good leadership? Check Glassdoor to see if the employees are happy. This isn't about some complex financial modeling. It's about using common sense and the information that's all around us to form your own judgment. You can even build a simple, repeatable system. 4 times a year, every public company has to release its report card, its financial statements. If you just take a few hours each quarter to look at those numbers, make sure you understand what the company actually sells, get a feel for its leaders, and see how it stacks up against its competitors, well, you're already giving yourself a huge leg up on most investors out there.
But look, whether you go with index funds or pick your own stocks, the end goal is really the same. It's about playing the long game. And that game, it's about so much more than just piling up money.
This quote from someone who's been investing for over a decade just says it all perfectly. After 12 years, through all the market's craziness, their investments gave them something you can't buy: flexibility, the freedom to choose where to live, where to work, the confidence to handle whatever life throws at them. That right there is the real return on investment. It's priceless.
So what does it take to win this game? It's not about having a fancy finance degree. It's about having patience, thinking in terms of decades, not days. It's about having the right temperament, staying cool when everyone else is freaking out. It's about having a real desire for the freedom this can bring. And maybe most importantly, it's about having humility, the self-awareness to know that if your stock picks aren't doing better than the market, the smartest thing you can do is just buy an index fund and call it a day.
So let's end with this thought. The next 20 years are gonna go by no matter what we do. They're coming. The only real question is, when they get here, where do you want your money to be? Do you want it to have just sat there, maybe even losing value to inflation? Or do you want it to have been working for you, building a future with more freedom and more choices? The clock is ticking. The choice is yours.
All right, let's dive right in. We're going to talk about some timeless wisdom for navigating what can feel like a pretty chaotic world of modern investing. You know, the goal here is super simple. It's all about helping you become your best investing self.
I know, with all the noise out there, it might not always feel like it. But honestly, we are living in an absolute golden age for investors like you and me. I mean, just think about it for a second. You've got instant access to global markets, top-tier research, powerful financial tools, all on your phone. Stuff that used to be locked away for Wall Street pros, it's now at your fingertips. The playing field has never been more level.
But, and this is a big but, there's a flip side to all that power. The very same thing that makes this a golden age also makes it dangerously easy to mess up. That scary headline pops up and you panic sell. You see everyone else getting rich and you jump in, driven by FOMO. A decision that could totally derail your long-term plans is literally just one bad click away.
So, that brings us to the big question, right? If the tools are there for everyone, but the chances of making a mistake have gone through the roof, how do you actually win this game? What's the thing that separates the winners from everyone else? Well, the answer, it might surprise you.
Okay, first things first. We have to talk about the real cost of investing. And spoiler alert, it is probably not what you think. When people hear cost, their minds jump to fees and commissions. But the true price you pay to play on the market, the toll you have to endure to get those long-term returns, that's something else entirely.
This quote from Morgan Housel just nails it. Investment fees are falling, but investment costs are not. It sounds simple, but that distinction is so important. The financial fees you can see on a statement, yeah, those are going down. But the emotional costs, they're as high as they've ever been, maybe even higher. Let's really unpack what that means. So look, on one hand, you've got the financial fees, trading commissions, fund expenses, all that stuff. And like we said, those are shrinking, which is awesome for all of us. But then you have the emotional costs. We're talking about that gut-wrenching fear when the market tanks, that little voice of doubt telling you your strategy is all wrong, that surge of greed when it seems like everyone else is getting rich. That stuff is fueled by the 24/7 news cycle, and you don't pay for it in dollars, you pay for it in stress. That is the real price of admission. So what does this all boil down to? It's actually pretty simple. Success in investing isn't really about finding the next Amazon or making a bunch of genius moves. It's about one thing: avoiding the big, catastrophic mistakes. Like selling everything in a panic right at the bottom. That's the kind of move that can wipe out years of hard work. It's way more about playing good defense than just having a killer offense.
I mean, think about how much things have changed. Back in the day, winning was all about who had access to secret information or expensive tools. But that's just not the case anymore. Low-cost funds? Everyone's got them. Instant news? Check. Fancy tracking software? Yep, that too. All the tools are basically universal now, which means the number one skill you can have is just keeping a level head when everyone around you is freaking out.
Okay, so if it's all about behavior, what's the one behavior that really moves the needle? I'll tell you what it is. It's patience. Seriously, in the world of investing, patience is an honest-to-goodness superpower. Oh man, I love this analogy because it is just so spot on. Investing is a marathon, not a sprint. Real, lasting wealth gets built slowly, piece by piece, over years, even decades. But so many of us get frustrated because we're trying to sprint it. We're checking our portfolios every 5 minutes, trying to predict what's going to happen tomorrow. And let's be real, that's not investing, that's just gambling. And it's a perfect recipe for a whole lot of stress and some really bad decisions. And this gets right to the heart of why patience is so hard. Think about it. Progress, the good stuff, it happens so slowly you barely even notice it. But setbacks, man, those happen so fast you can't possibly ignore them. Our brains are just wired to pay attention to sudden, scary things. A market drop feels like a fire alarm going off. But that slow, steady compounding, it's quiet. It's almost invisible. The bad news yells, and the good news whispers.
Let's look at a real-world example. Remember 2008? The market crashed, losing about 38%. It was awful, terrifying. People were scarred by it. But then look what happened next. From the low point in 2009 all the way to 2015, the market more than tripled, a 200% gain. But do you remember that feeling as intensely? Did that get the same screaming headlines? No way. The sharp, sudden pain of the loss sticks in our memory way more than the slow, much bigger gain that came after.
And that's exactly why you see so many pessimists out there, even though over the long haul, things have generally gotten better. This weird quirk in our brains explains why being negative always sounds smarter, more sophisticated. It's why bad news feels so powerful, even when the data, over time, tells a story of incredible progress. It's like we're built to remember the lightning strikes, but we forget to appreciate the sunrise.
Okay, so if the old edge of having better information is gone, what's left? Where do you, the individual investor, actually find your advantage today? Well, let's talk about the new rules of the game.
This right here is the whole ball game. Let's be honest, you're not going to outsmart the entire market. You're up against millions of smart people and supercomputers. You can't win that game. But you can be more patient. You can be less emotional, and that is where your edge is. It's not about being smarter, it's about being more disciplined. Your advantage isn't in your IQ, it's in your behavior.
So let's just lay it out. Old school versus new school. 30 years ago, the edge was all about analytical skill and getting information nobody else had. Fast forward to today, information is everywhere. It's like drinking from a fire hose. And computers have pretty much leveled the playing field on analysis. The new edge, the one that's going to matter for the next 30 years, is all about patience and emotional control. It's a total shift.
And all of this leads to a piece of advice that is so simple, but man, is it hard to follow. For most of us, most of the time, the absolute best thing you can do is nothing. Seriously, just don't do anything. Let your plan do the work.
And here's why doing nothing feels so wrong, especially for smart, ambitious people like you. In almost every other part of your life, your job, the gym, learning a new skill, more effort equals better results. It's just how the world works. But investing is this weird, upside-down place where often the more you do, the more you trade, the more you react, the worse you do. Your own desire to take action can actually be your biggest enemy.
So, let's bring this all full circle, back to where we began. Once you truly understand this stuff, once you accept that your behavior is your greatest asset, not how smart you are, then you realize there has never, ever been a better time to be an investor.
No, seriously, I mean that. Ever. In the entire history of the world. The fact that you can build a low-cost, globally diversified portfolio in a few minutes on your phone, that's nothing short of a miracle. The door to long-term success is open to more people now than at any point in human history. It's something we should really appreciate.
Which leaves us with one final and really important question. The tools for success are out there. They're cheap, they're powerful, and they're available to everyone. The real question is your temperament? Can you master the one thing that truly matters? Yourself.
Have you ever felt like investing is this super complex world, just for Wall Street experts? Well, we're here to show you a different way. We're going to unpack the Motley Fool Investment Guide, and I promise by the end of this, you won't just get their core philosophy. You'll have the first real practical steps to take control of your own financial future. All right, let's dive in.
So, the Motley Fool's entire identity, it's built right on this quote from Shakespeare. Now, it's not about being an actual fool, of course. It's about embracing what they call foolishness, and that just means an investing approach that's humble, it's curious, and it's self-aware. It's about admitting you don't have all the answers, which, when you think about it, is the very first step to making truly wise decisions with your money.
All right, so here's our roadmap for today. We're going to start with the most important part, the right mindset, what they call the foolish philosophy. Then we'll get into the nuts and bolts. What even is a stock? How are they traded? And how do you pick a broker? And we're going to wrap it all up with some brilliant and honestly hilarious lessons from the Fool's famous court jester.
Okay, first things first. Before we talk about any ticker symbols or what the market's doing, we have to talk about mindset. The whole foolish philosophy argues that great investing, it doesn't start with some complicated chart. It starts with a simple decision, the decision to take control of your own financial destiny.
Their mission is really fascinating because it's not just about the money. The goal isn't only to make you richer. It's to educate you on how this whole thing works and, get this, to make the process enjoyable, to amuse. And that's brilliant because the idea is when you actually understand something and find it kind of fun, you're way more likely to stick with it and, well, succeed.
So here's the first principle, and trust me, it's a big one. You are the absolute best person to manage your own money. Why? Because you and only you have your own best interest at heart, 100% of the time. Think about it. A broker might be motivated by commissions, right? But every single decision you make is perfectly aligned with your future. And the guide is totally firm on this. With a little discipline, an individual investor can absolutely beat the market averages.
And they even put a number to it. The Motley Fool believes that a 15% annualized growth rate is totally achievable for an individual who does their homework and, crucially, stays patient. Now, that's a few points higher than the historical market average, but what does a number like that actually mean for your money?
This is where it gets really, really powerful. This is the magic of compounding returns. So let's walk through this example. Say you start with $25,000 and you manage to add just $2,500 each year. Well, if you hit that 15% annual growth, in 23 years, that nest egg turns into $1 million. See, it's not about getting rich overnight. It's about this incredible, unstoppable snowball effect of time and consistent growth. Your money starts making money, and then that money starts making its own money. That is the engine of wealth.
So, we've got the mindset down, and we've seen the incredible potential. But what are we actually buying when we invest? What is a stock? To understand that, we're going to use the book's fantastic little analogy of a fictional startup they call Flubsoft.
So what is a stock? It's really simple. It's just a share of ownership. The formal name is equity. So imagine our company, Flubsoft, needs money to grow, to hire people, build a factory. Instead of going to a bank and getting a risky loan, it can sell off little tiny pieces of itself to investors. And now those investors own a slice of the company, and they get to share in all of its future success.
And here's the core trade-off for any new business. On the one hand, Flubsoft could go beg a bank for a loan. That's called debt financing. But since it's a new company, that loan's going to have a super high interest rate that could literally crush them. The other option is equity financing. They sell shares and avoid all that costly debt, but, and here's the catch, the original owners now have to share all their future profits with their new partners, the shareholders.
And this is pretty much the life cycle of a growing company. First, maybe Flubsoft sells a big chunk, say 40%, to a venture capital firm to get going. Then, when it needs to raise even more money, it holds an initial public offering. You've heard of it, an IPO. And that's when it sells shares to you and me, the general public, for the very first time. Then, years down the road, if it needs another big injection of cash, it can issue a secondary offering, selling even more shares.
Okay, so Flubsoft is now a public company. Its shares of ownership are out there, available to millions of people. But
where do those shares actually get bought and sold? Well, that brings us to the marketplace itself.
These shares trade on what are called stock exchanges. And you've heard these names before, but their differences are actually pretty important. You've got the New York Stock Exchange, the NYSE. It's the oldest, has the toughest rules, so it's home to these giant established companies. Then there's the NASDAQ, the first all-digital exchange, famous for younger, faster-growing tech stocks. And then there's this really fascinating one called IX, which was designed to intentionally slow trades down by a few milliseconds, just to level the playing field so these high-frequency trading firms can't get an unfair edge. Pretty cool, right?
Okay, here's a key piece of jargon you're going to run into, so let's break it down. The bid-ask spread. When you look up a stock price, you'll almost always see two numbers. The ask is the slightly higher price you pay to buy it. The bid is the slightly lower price you get if you sell it. That tiny little difference, sometimes just a penny, is the profit that the market makers, the people facilitating all these trades, pocket for themselves billions and billions of times a day.
So we know what a stock is and where it trades. Now, for the most practical part of all, how do you actually get in on the action? Well, you need a broker. Think of it as your personal gateway to the entire stock market.
And you've basically got two main choices. On one hand, you have the full-service broker. This is the traditional model. A salesperson gives you advice, they place trades for you, and they charge a pretty hefty commission for it. On the other hand, you have a discount broker. This is for the do-it-yourself investor. They just provide the online platform for you to place your own trades for a much, much lower fee, but they're not giving you any advice.
Now, the Foolish Guide raises a huge red flag here: the conflicts of interest at these full-service firms. See, their investment banking side makes massive money helping companies go public with IPOs. So their brokers are often pressured to push those same IPOs onto their clients. A recommendation might be great for the firm's bottom line, but not necessarily for you. And get this: when a Wall Street analyst rates a stock as hold, it very often really means you should probably sell this, but they don't want to say that out loud and anger a company they have a lucrative relationship with.
So what changed? What made all this DIY investing even possible? It was this single moment right here, May Day 1975. The SEC got rid of the old system of fixed high commissions. And just like that, brokerages could compete on price. This kicked off a massive price war and gave birth to the entire discount brokerage industry, which made investing affordable and accessible for millions of everyday people for the very first time. It was a total game changer.
And that brings us to our final section. We've covered the philosophy, we've covered the mechanics. Now let's look at how the Motley Fool uses its jester persona to teach some of the most critical and often ignored lessons in the world of finance.
So every single April Fool's Day, without fail, the Fool launches an incredibly elaborate, all-out hoax. But these aren't just simple jokes, they are masterfully designed parodies. Each one is carefully crafted to expose some piece of expensive nonsense, or humbug, as they like to call it, from the financial world, in a way that's both memorable and super effective.
Let's just look at a few classics. So back in 1999, at the absolute peak of the dot-com bubble, they announced a fake IPO for eMeringue.com, a service that delivered meringue online. The lesson? Beware of IPO hype. Then in 2014, they launched FoolCoin, a brilliant parody of crypto teaching that pure speculation is a really dangerous game. And my absolute favorite, in 1998, they published a correction claiming an intern read a chart upside down, and that actually 91% of mutual funds beat the market, only to reveal, of course, that the original, depressing statistic was correct all along.
And this just shows you how well these pranks worked. They actually got people to stop and think critically. This is a real email from a reader about that eMeringue IPO, pointing out the completely absurd business model that thousands of people online were excitedly falling for. It's just parody as a powerful, powerful educational tool.
So let's wrap all this up. What are the essential things you need to walk away with? First, you not only can, you absolutely should manage your own money. Second, be patient. Think in terms of decades, not days, and learn to ignore all that daily market noise. And remember, a simple, low-cost S&P 500 index fund is a fantastic default option for anyone. And finally, being truly foolish, it means having the courage to buy into great companies when everyone else is panicking and the market is tanking.
We'll end with the same question the guide asks its readers. After seeing the incredible power of compounding, after learning the core principles of long-term investing, the real question isn't about what the market's going to do tomorrow. It's about what you are going to do for your future. So, where are you going to be in 2040?